Hello, my voice is audible, sir? My voice is audible. My voice is audible.
Yes, sir.
Okay, ma, thank you. Ma. Just wait for 2 minutes, ma. No, no, no. Yesterday we discussed on all the first and the remaining two topics are there. We will cover the key topic within 20 minutes and we'll move to the second unit. I can essence of that first unit, last two topics I will cover. What are the questions were asking the question paper? I will cover that topic. Camel's method. You can expect question from Camel's method. Camel's method. It's very useful for banks because banks want to protect the customer money and also bank want to protect bank want to protect capital amount. That's very important. Capital structure is very important. Bank lost the capital structure means they lost their bank entire coming under bankruptcy. Bankruptcy means bank all the money were gone. Their their bank were answer to the public. For that purpose, they introduced Camel's method. Camel's method means capital adequacy. Capital amount is very important. Capital adequacy. Then M for monitoring. M for monitoring. E for earnings. L for liability, and S for sensitivity. That is called as Camel's method. Camel's method is always helpful for banks to protect the capital amount and also monitoring the entire activities. So RBI also framed the framework of Camel's method: capital adequacy, monitoring, earnings, liability, and sensitivity. You see that Camels. C for capital adequacy. Capital amount is very important for banks. Banks is always maintain the capital amount. Suppose they lost their capital amount means they're coming under bankruptcy. Already I told 3 month amount. Suppose you are lending loan to the borrower within 3 months, that is coming under the three type NPA, non-performing asset, performing asset, semi-standard asset. Within 3 months they repay the loan amount means that's a performing asset. Within 6 months they repaying the loan amount means substandard asset. They will not repaying within 1 year means that is coming under NPA. They want to reduce the NPA, non-performing assets, through Camel's method. They maintain the capital adequacy. M for monitoring. They always monitoring the deposit amount where they lending the money to the different people. They are they monitoring the every deposited money, because the deposited money were lending to the. Hmm. Savita. Semi-standard, sorry, they want to monitoring every depositor's money, because the depositor's money, the full money, has not lending to the only one person, because they received 10,000 rupees, they received a amount of 1 lakh, 2 lakh, 5 lakh rupees, means their bucket systems are available in the RBI, and banks also follow bucket system. 10 lakh money categorized for 3 month period, 6 month period, for 1 year period. The different portion of amount they were lending to the different people. Different people. That's why coming under monitoring, cameras for the capital adequacy, monitorings, and the earnings. Earning means earnings is very, very important for bank purpose. Generating income based on loan, lending loan to the borrowers. So earnings is very, very important. Liability also you have to follow liability. Then sensitivity. Market is bank always depend on market. That's called as Camel's method. The Camel's framework composite of evolution banks. These are financial intermediary in general. To capital adequacy, you see the capital adequacy is a measure of financial strength, in particular ability cushion operation abnormal losses. They want to stop the abnormal losses. It is calculated based on asset structure of the bank. I know the asset structures, and also can be as a regulated for each asset classes. Otherwise, amount, deposited amount, every deposited amount lending to the borrower, every regulator asset should be monitored by through capital adequacy. Then asset quality. The quality of asset is very, very important. Asset quality, because we are lending loan to the borrowers. We just like a portfolio management. It's like a portfolio management. Asset quality is very, very important, because to stop the loss of loans from the banks. Then management. So management is obviously is very, very important. Management where management where the parameters, all the parameters, and also they are monitoring the employee of that bank, and earnings per employee, earning per. So everything is monitored by management people. Then earnings. This calculation ratio and return on assets. Return on asset means everybody should know about return on asset. Whatever you can lending money, banks. That is the asset of the bank, lending to the borrower, because we are debitor versus we are money deposit for the lending purpose. So lending, whatever money you are lending in borrower, that is coming on asset, return on asset. Your asset will generate return for the bank. That is earning. Then liquidity. Liquidity flow is very, very important. Once liquidity flow stops in a banks coming under bankruptcy. So liquidity is very, very important. Inflow, outflow is very, very important. Then based on the sensitivity market is already sensitivity means what? Because market, because banks, all financial institutions, all financial institutions depend on market. That's why they are sensitive to market risk. We invest money in investment banks, portfolio management, uh, uh, use banks or deposit different, lending to different sector are generated. So based on their is for operation risk is there, many risks were so deposits amount, loan amount. That's why we called as sensitivity to market risk. This question also to be asked in 5 mark questions. Camel's method. You can expect this question. And asset and liability management of bank. Asset and liability management of bank. So asset and liability is very, very important. The two parallel, they want to maintain the equilibrium between the asset and liability management of bank. Asset also very, very important. Liabilities also be there, because liability means they can repay the amount deposited. That is called as liability. Depositor. Asset means they will generate asset from the depositor money, the lending money to the borrower. That is called as asset and liability of the bank. Banks always trying to to maintain the liquidity, and also they always depend on interest rate. Always depend on, both are agreed between the depositors as well as the bankers, depend on interest rate. Then banks will agree with the borrowers, depend on interest rate. This is called as asset and liability management of the banks. So they're managing both asset and liabilities very equally and stably. That is called, they introduced ALM method, asset and liability management in banks. So asset and liability management is very, very important in bank structures, because ALM information systems, MIS, connected with MIS structures and responsibilities, and ALM process, risk parameters, identifying, measuring, managing risk, setting risk policies and tolerance levels. ALM method is very, very important because of present days asset and liability. Banks were maintaining asset and liability is quite difficult. NPA is increasing. 15 lakh crores, 15 lakh crores or 10 lakh crores. Government of India, government of India to giving benefit to the corporate never repaying money to the banks, and also other people, the agricultural loan followed by other small scale industry loan, wave off were happen in India, because they are not repaying. But the corona time, how it is possible to repay money to the banks? Because of failed, all the business were a failed condition at the time of corona and followed by other years. It's quite difficult for other people to repay the money. It's the government of India to waive off that money to the corporate as well as many individuals. But still, that's why they maintain the ALM method, asset liability management method. They are not without repaying capacity people. They are not lending money to the repayable capacity people, because they're borrowing money. They enjoying the benefit. They all the money where they are all the money were enjoying the benefit. They not repay money to the banks. So banks were seriously to see that, identifying the people they having a repayable capacity to the loan. That is very, very important. So and everything. So information system is very, very important. All the information should be stored in information systems, understand responsibilities. Every transaction should be updated. Every person should be monitored. And also RBI should monitor Camel's method, RBI should Camel's method, and ALM, and followed by capital adequacy is very, very important. Capital adequacy, capital amount. At least you will not lose your capital amount. That is very, very important for banks. And monitoring by bank, capital adequacy, monitoring, market risk, interest rate risk, operational risk, everything, liquidity risk, everything is very, very important. To protect the norms is very, very important. And followed by Basel Accords, introduce many revolutions were happened. Basel Accord, Basel 1, 2, Basel 3, and Basel 4, and Basel 5 in all, because of to protect asset and liability management. For the purpose, they started asset and liability management is very, very important for asset policy for banks. Then checks and crossing checks, endorsement, you have to go through that. It's very easy. It's coming under Negotiable Instrument Act, because it's equal to current coming under Negotiable Act India 8. All checks, practice 3 in check, checks, everything is there. You can go that also 5 more. Now I move on to second unit. It's called as a bill of exchange. Negotiable Instrument Act is also called as exchange. You can exchange the cakes equal to the currency. That's why we call it as bill of exchange. See the okay, pay to buy piece. This number is very important. Number number the number is equal to a currency because this number is very important. This number is back. No, voice is audible, ma. Just now, I lost my network, ma. My voice is audible, ma.
Yes, sir.
Hello. Okay, ma.
Yes, sir.
Okay, notes is visible. Notes is
Yeah,
visible,
visible,
ma.
sir. Visible,
Okay,
sir.
ma. Okay. Okay, ma. Second unit, important question. We are discuss on functions of RBI. What is the main functions of RBI? RBI is a central bank of our India. RBI is a monetary policies. RBI issuing currencies. RBI issuing currencies only. Ministry of Finance only issuing coins. The two differences there. RBI issuing currencies and the Ministry of Finance issuing coins. So functions of RBI. Reserve Bank is a, already I told, it's an umbrella of all the financial banks in India. So all the banks coming under RBI. That is called as that's why they called us umbrella. So what is the main functions of RBI in India? All the banks, they are all the development banks, the nationalized bank, private banks, foreign banks, cooperative bank, regional rural banks, and development banks, separate banks, NABARD, SIDBI, and housing finance banks, and followed by NBFCs. All the banks were controlled by RBI. So their work is very huge work because our India depend on financial systems is very strong in India. The financial systems should protect the public money, people money, because we are deal with public money. Anything to be happen, RBI were answer to this public because they want to protect the public money and also safety, liquidity, everything. RBI. Suppose any bank were lost there, any banks, any nationalized bank, any private bank, what loss were happening don't bother about their money because they are depend on RBI. RBI prepay the money along with interest rate. People that not bother about very confident about their money because RBI protect money. That's the fund where running by Reserve Bank in the present days. Numerous activities. So the numerous activities we are going to discuss the numerous activities one by one. First one is monitoring and for a issue of currency. Niche of finance issue of coins. So you always make who is issuer of currency, who is the issuer of coin. So all the currencies, Ministry of Finance issuing the coins. So monetary authority, issue of currencies, government. Then that's why we called regulator of banking systems. Manager of foreign exchange, manager of foreign exchange, whatever exchange foreign currency. All the transactions recorded, every transaction very important. Even single $1 or 50 lakhs dollars, whatever it may be happen, every transaction should be recorded and also RBI. If you have excess of foreign reserves, that will show the economy. So RBI functions. Hello. Hello, my voice is audible, ma? Hello.
Yeah, sir, audible.
Where I left, ma? Connection network was left. Which point? Monitoring authority or issuer of currency or bankers of debt. Where I? Hello. Hello. Vijay.
Yes, sir.
Which one, ma?
Functions of
That's
RBI, sir.
okay. Functions of RBI. So RBI is
Yes.
the monitoring authority. Monitoring authority means they are the policy makers to all the banks. All the banks depend on RBI because RBI is umbrella. All the nationalist bank, foreign banks, and followed by private banks, cooperative banks, regional rural banks, and development banks like IDBI, SIDBIs, and NABARD, and followed by investment banks, and followed by microfinance bank, and followed by Mahela Bank, and other banks, NBFCs, mutual fund companies, and other finance companies coming under RBI umbrella. That's why RBI called as a monitoring authority. And our issuer of currency. Issuer of currency means RBI were issuing the currencies, and Ministry of Finance were issuing the coins. This is the difference between issuer of currency and the issuer of coins. So always not to be confused. RBI is the issuer of currencies, and the Ministry of Finance were issuing the coins. Then banker and debt manager to government. Banker and debt management to government means it's always banker to protect the amount. Debt managers. Debt amounts borrowed amount to protect the borrowed amount. That's why Debt manager to government. Government should borrow money from RBI only. Suppose anything to happen in economy, they want the money for to money circulation. They want to protect the economy. Some things, anything to be happen like COVID-19, natural disaster, followed by other disaster will happen. They borrow. Government should borrow money from RBI. That's why debt managed to government. RBI is a debt managed to government. Anything, any economic situation, any economic problem where happen, government depend on RBI because RBI is the backbone of our India. RBI is a backbone, not only agricultural backbone. RBI is also backbone of our India. Then bankers to banker. Banker means RBI is a central bankers. RBI is a central bankers that will always banker to banks because they want to all the banks were follow the RBI rules and regulation, RBI policy. That's why we called as RBI as a banker to banks. Then regulators of the banking systems, regulator of the banking system, all these repo rate, reverse repo rate, SLR, CRR, and followed by bank rate, all the rate were all the rate revised rate and repo rate and reverse repo rate revised by RBI. RBI were controlling the money circulation. RBI will do all these financial activities of the banks. That's why we called as regulator of the banking system. RBI is the regulator of the banking systems. Then managers of foreign exchange, manager of foreign exchange, because we know that manager of foreign exchange means every transaction should be recorded, because any one countries, any world countries, to show the potential foreign reserves, they have excess of foreign reserves. They always maintain the foreign reserve, means that economy is the strongest economy in the world. Strongest economy in the world. That's why every transaction should be recorded in RBI. And the balance of sheet should be, every foreign transaction should be recorded. Either current account or capital account should be recorded in RBI. Because nowadays foreign transaction means positive is also be there, negative is also be there. Suppose Money Laundering Act, you know that. Surpass Act, you know that. Money Laundering Act means they were using that money, foreign money, for wrong purpose. They buy that war weapons or also create a problem among the nations. For that purpose, they are using foreign money. To stop all this activity, so RBI should monitor every foreign exchange transaction. Then export and import, they encourage the export people, because do more export, we attract more foreign reserve. They encourage the FDI people, foreign direct investment people, because all the foreign people directly invest money in India without any tax except there. All the tax exemption given by the government of India, they enjoy the benefit. They will enjoy the benefit and also start a business. India will attract foreign reserves through that way. Then FII, financial institutional investors, through capital market, foreign investors to invest money in Indian stock market. That type of also we can attract foreign exchange. Then tourism, medical tourism, many way to attract education, many way to attract foreign exchange. So all the transactions should be recorded. Because all the transactions should be recorded, we want to avoid the Money Laundering Act. We want to avoid the illegal transaction of the banks. We want to avoid the terrorism. So that's why manager to foreign exchange, manager of foreign exchange. Then regulators of supervisor of the payment and settlement systems. Regulators of supervisory and payment systems. All the payment systems, RBI are regulators. All the payments, settle the payment, because every person to person transaction, person to many people transaction, bank will settle the amount to the people. Bank will settle the amount to the customers. That's why we called as a regulator and supervisor of the payment and settlement system. And development role, our Indian economy development role done by RBI only. Many situations were happened in India. So RBI 2008 crisis, already yesterday I told you, very 2008 is a huge crisis, for financial crisis for throughout the globe. That's why we call it as subprime lending. Subprime lending means India, foreign, that American banks do not do not analyze the borrowers personal information and borrowers salary information, borrower asset information. So they are lending money to the borrower. Borrower is not ready to repay that amount along with interest to the bank. And also bank, where the borrower were buying the land Finally, what will happen? Bank will lending money to the borrower. They are not repaying the loan. Later, they were sell that land at the higher rate. But unfortunately, this reverse proposal were happen in US, because all the banks were lending money to the borrower without seeing the repayable capability. They are not repaying the loan along with interest rate, and also they are buying the land. Finally, the land value also decrease. The repayable without repayable capacity, they are lending loan to the borrower. They are not repaying the loan to the banks. So huge crisis were happen in the 2008 market. At that time, also RBI play a vital role throughout the globe. RBI and India and China show the strength to the world economy. India maintain the 9% GDP, and China will maintain the 12% GDP, because their central banks policies and followed by other activities is very strong. And the federal bank activities, federal bank never enter into the subsidy banks, like banks to the banker. We discuss no banker to the banks. Federal bank never enter into the decision of banks of the America, because all the banks have an autonomous body. They have taking their own decision. They have taking their they are taking the own risk to form the interest rate and policies, whatever it may be. But in India, all the banks depend on RBI. RBI is the monetary authority. We follow the RBI rules and regulation, because we are deal with the public money. We are deal with the public money. We answer to the public. We always protecting the public money. We always safety, liquidity, security. That is very, very important. That's the four things we expect from our people: safety, liquidity, interest rate, and security. These were maintained by the RBI. That is called as functions of RBI. This question you can expect in 10 marks more. In second unit. You simplify the not to write all these next one, monetary policy India, and method of credit control and autonomy of central bank. Credit control and the autonomy of central banks. Objectives of monetary policy. What are the objectives? Price stability, economic growth, then financial stability. Price stability and economic growth and financial stabilities. Definitely, monetary policy is called as a flow of credit to productive price stabilities. Flow is very, very important. Flow of credit. How much money you can lending to the borrowers. That's the flow of credit. That is very, very important. To the productive sector, that is very, very important. You lending money to anyone, but that money will be generate income, generate asset for the banks. That's very, very important, because we are borrowing money from the public money, then lending money to the different sectors, industries like big industries, small scale industries, medium sized industries, and individuals, and agriculture people, and below poverty line people. Many people were lending loan to us, because that is a bank also borrow money from the depositors. Based on that, they are lending money to the borrowers. Banks, debtors to the creditors, debtor to the creditors, and creditor to the debtors. This is a role followed by the banks. Debtor to creditor means depositors credit money to the banks. Banks will repay money to the depositors. Here, creditor to the debtor. So banks lending money to the borrower repay money to the banks. So the price stabilities, and that money will generate income for the banks. That is very, very important. That's why they're saying what monetary policy evolved, maintaining price stability and also flow of credit to the productive sector of the economy. So we progressively increasing what liberalized after 1993. Our farmer Narasimha Rao, and followed by our former finance minister Manmohan Singh, to open the gate of LPG, liberalization, privatization, and globalization. And also yesterday class we are evaluation happened in banks, reforms were happening in banks, and new revolution were happening in banks. 1969. Start from 1919. Later, all the banks were combined together. Which one? Bank of Bengal, West Bengal, Bank of Maharashtra, sorry, Bank of Bombay, Bank of Madras. All the banks were joined together. It is called as a State Bank of India, 1935. Then after revolution were happened, after getting the freedom, 1956 and 1969, one of the big revolution were happened in India. All the banks were, 14 banks were national banks announced by our former Prime Minister Indira Gandhi were announced. 1969, 14 banks were nationalized. Then followed by 1980, remaining 6 banks were nationalized, nearly 20 banks. So all the people were entered into the bank sector. All the people, even top to bottom people, were entered into the bank. They were entered into the bank. After that, reforms were happened. 1993, they opened the gate of LPG, liberalization, privatization, globalization. We also open the open economy to all. Open economy to all. Anyone can do a business in India, and also create a competitive, more competitive and a strong competitive among the industries. Not only industries, private industries were entered into the India. Then private industries started a bank. All the banks were computerized. All the banks were computerized. Previously, they were running the banks. Banks were mortar and bricks branch, like physical branches, a table, bricks, mortars, and followed by other things. Now, after reforms were happened, 1993, what were happened? Computerized, digital were introduced in India. Digital were introduced in banks. So after that, all the transactions were done. They settled the amount easily to the customers. They were not taking a long time to settle the amount. Within a day, they were settled the amount because all the banks were centralized. That is very, very important. This all the reforms were happen. So after that, the adequate flow of credit to the productive sector of the economy. After liberalization, many private industry were entered into India. So India banks also lending money to the private sector people, as well as other private sector, means many sectors were there. That sector itself, they generating income for the banks because they are borrowing money after they are along with the interest rate, and also they repay money to the banks. And also banks were maintaining the long-term relationship with the corporate people. Corporate people never running their business like single business. They were expanding the business because they're going for portfolio management. They can expanding the business, new business. They were not doing only same business. According to the market, they were according to the competitive world, they were doing many business. So banks were also lending more money to the different sector. That's why we maintain the price stability. That's why we called as with progressive liberalization and increasing globalization of the economy, maintaining order condition in the financial market. Financial market is very, very important, like stock market, capital market, commodity market. So all the markets coming under capital market. In additionally, policy objectives. That's monetary policy in India is always judicious balance between the price stability. Price stability is very, very important because the world economy based on maintain the price stability. Dollar value increase and decreasing. You are doing export and import, so you maintain this price stability. And the economic growth. All these business based on economic growth. Every individual per capita per income. Individual per capita per income, standard of living, employment opportunity, education, health, these all called as coming under economic growth. Every individual per capita per income is very, very important. So, and financial stability, they're maintaining the financial stability. Financial stability, you take the example of financial stability, even global market is fall down, our Indian financial stability is not a weak in condition. They were maintaining the financial stability based on RBL monetary policies. With the help of RBI monetary policy. This is called as what? Financial stability and price stability and economic growth. Indians always savings economy. They always expect savings economy. Then operating procedure of monetary policy in India, choice of operational target, nature, extent of frequency, different money market operation by the central bank. Money market, you know that what is meant by money market. Later I will come by money market. Money market is Reserve Bank of India issued treasury bill. Within treasury bill and followed by other bills were issued. Bond were issued by Reserve Bank of India. That is called as money market operation by the central bank. That is also because they need more money. They want to control the price stability. They want to control the financial stability. People doesn't have excess of money in their hand because the money doesn't have value. They want to price stability. They want to money circulation. They want to economic growth. They want to financial stability. Means RBI also issue bond to the public along with interest rate short term with 90 days bond, 2 for 180 days bond, and followed by 3 within 1 year period. That's called as money market instrument. 1 day to 360 days. Within 1 day to 360 days issued by RBI. That is also to want to flow of money circulation to control the financial stability, to control the price stability. For that purpose, government of India, sorry, RBI also deposit, they're collecting deposit, mobilizing money from the public in terms of money market. Then use of short-term market interest rate, already told short-term market, and followed by operating procedure explained here. LAF, issue of options, liquid adjustment facilities done by only RBI. It's issue of liquidity adjustment facilities. Then followed by monetary transmission where happen, monetary policies, interest rate, and followed by other things where transmission that happen. Then policy rate, very very important. Then bank rate fixed by RBI. Bank rate, or SLR rate, and CRR rate, repo rate, reverse repo rate. All this will be followed by RBI only. CRR, cash reserve ratio, maintaining the cash reserve ratio, then security liquidity ratios. These all the rates reserve maintaining by RBI because any banks were lost that CRR rate and SLR rate to protect that banks. So start from the banks, RBI start from the you want to start a new banks, you can maintain in terms of cash, in terms of gold, maintaining in RBI, deposit in RBI in terms of CRR and SLR. Anything to be happen, that money will protect the banks. For that purpose, they are maintaining CRR and SLR. Autonomy of all central banks. So autonomy of central bank systems. So you can expect this question also from your second unit, from autonomy of central bank systems. So what is autonomy means? Reserve Bank having their autonomous banks. They were controlling the bank to all banks. We already discussed. That's why called as autonomy of central bank system. But if you same is not applicable in throughout the globe. Very similar countries where autonomy of central bank systems. So central bank systems, no one interfere in the central bank decisions. Even central government also not enter the central bank system. That's why we called as autonomy of central bank systems. They will strictly follow the rules and regulations. They want to protect the public money. Then the first variable, they introduce personal independence, government distance itself. As I told, personal independence from government distance itself. That's why we call this. That's how it goes. Then financial independence. Financial independence. They do not depend on government. They have financial independence are there. Freedom of the central bank to decide extent to which government expenditure, either directly or indirectly financed via central bank credits. That is called as financial independence. Also be there for central banks. Then followed by policy independence. They will take the policies like repo and reverse repo, bank rate. They were changing the rate according to the market. That is called as a policy independence. It related to flexibility given to the central bank, formation and the execution of monetary policies. Formation and the execution of monetary policies. Then goal independence. Goal independence mainly were to reach the people. To reach the people. The policy is always giving priority to reach the public, to reach the benefits of the public. That is called as goal independence. Final goal is what? To strictly follow the rules and regulation, ALM method, Camel's method, to not lose the capital amount of the bank. They want to protect to lose the capital amount of the bank. They always maintain, they always reduce the NPA, non-performing assets. What are the rules framed by RBI, policy to framed by RBI to protect in the term of what? NPA, non-performing asset money, to protect. The banks always performed assets. Whatever asset they are lending money to the borrower, the asset was performed to stop the non-performing assets. For that purpose, RBI put more regulations, strictly follow rules and regulation, monetary policies. That is called the goal independence. Next one is instrument independence. Instrument independence means RBI suppose want to stop money circulation. They want to excess of money in people in their hand. They mobilize money from the public. That is called the instrument independence. They can issue treasury bill. They can issue bond to the public along with interest rate, along with 1 year. That is called as money market instrument. Money market instrument. So instrument independence also be there for central bank. Then evolving relationship with the government and RBI. Rangarajan Committee. So many people we know Rangarajan Committee. Rangarajan Committee, RBI governor, former RBI governor. He always what Rangarajan Committee instructed, and Rangarajan Committee where they defined what we need for India means institutional arrangement for the conduct of monetary policies, and condemn the practice of automatic monetization of government, fiscal deficit system, and issue of treasury bills, and the principal factor will helpful for the Indian context. Monetary policies is a Rangarajan Committee were introduced. Rangarajan Committee and followed by Narasimhan Committee. Rangarajan Committee and Narasimhan Committee, many phases were happen in India that are always protecting the public money, to reduce the NPA, and also to include the technology implementation in banks, to reduce the time, to reduce the cyber crime, to reduce other activities in the bank, to reduce the unethical transaction between the banks. So for all these stuff, all this committee were framed by to stop the to increase the bank asset, and also to increase the bank asset, to stop the NPA, and also to include more technologies to the banks to helpful for to increase the profit in the banks. That's why they specifically first phase, second phase. We already discussed first phase and second phase and RBA. Third phase was 1969, nationals of all banks. Fourth phase was April 1997. RBI issued treasury bills to be made by effective in 1997. Treasury bills, they were issuing a treasury bills, mobilizing money from the public. That independence given to the government from the government given independent to the RBI. That is called as fourth phase. Then Indian money market and capital market legislation. Then Indian money market, capital market. I will give the essence of that. What is from Indian money market? Indian money market means short-term money market. Short-term money market. And the Indian capital market means a long-term money market. Suppose RBI or any financial institution, government were issuing they need money for the urgent purpose. They need money for some financial crisis. So that is called as Indian money market or short-term money market. Short-term money market. So Indian money market means RBI, Government of India, state government or municipal or any company within short-term crisis were happen for their working capital management, for the short-term crisis or short-term financial crisis for India, they are mobilizing money from public. That is called as Indian money market. Mobilizing money from the public, that is called as Indian money market. 1 day to 360 days. The time period is 1 day to 360 days, called as Indian money market. 1 day money, notice money, call money, treasury bills, many bond, many name as called as Indian money market is instruments are available in Indian money market, along with interest rate 8% or 10% or 12% interest rate given by the Indian money market. Suppose RBI need money, short-term period, they are mobilizing money from the public. That is called as treasury bills issued by RBI. Treasury bills issued by RBI. Bond is issued by companies. Government companies issued by bond. Government, central government or state government, municipal or any other government or government organization issued bond. That is called as bond within 1 year period of time. Within 1 year period of time, and call money, notice money. Treasury bill issued by Indian money market. Indian money market. So you can, within a 1 year period of time, you can borrow the amount and can settle the amount to the lending people. Settle the amount to the issuers. Then capital market means capital markets a long-term market. That is called a stock market. They're issuing equity share, preference share, deferred shares, and followed by debentures, bond issued by the private sector people. Sorry, government issued by bond, private sector people issued by debentures and equity shares. This is called as capital market, long-term market. Long-term market. This is the two different market available in India: Indian money market and capital market and bank, capital market and banking legislation. How to control this entire things by banks, central banks? This question definitely can expect some more examinations. This we will discuss on next class. Thank you so much.
Good morning, all of you. Morning, all of you. Are you there, anybody? Hello. Why are you very silent? Are you listening, anybody? 17 are there. 17 are there, but nobody is responding. சும்மா ஆன் பண்ணி விட்டு போயிட்டாங்களா? பிருந்தா, தேவதர்ஷினி, தீப் கோஷ், Vijay Murugan.
Yes, ma'am.
Nobody is responding. That's why I have doubt whether you are listening or not. Okay. Shall I start the class?
Okay, ma'am.
Today, let us see budgetary and budgetary control. First of all, for management accounting, budgeting is very, very essential role of every manager, right? So you have to plan. Budgeting is what? It is a accounting plan. How much should be the production? How much should be the sales? How much should be the purchases you have to make during the year? So how much labor you have to pay? So all these things, each and everything, you have to be planned, right? So according to your plan, you have to execution will be success, right? So budget is a accounting plan. We can say it is a monetary, we can express in terms of monetary items, right? So yeah, these functional activities will be in quantifiable. That is first you have to forecast your demand, and then estimate the sales in various places. Then you have to find how much production you have to make. Then you have to see the raw materials. So all these things you have to decide, right? So budgeting mean ICMA define a plan quantified in monetary terms, prepared and approved prior to a defined period of time. So that too not a vague. It should be a defined period, 1 year, 6 months, 3 months. So whatever it may be, you have to define the period of time, and usually showing planned income to be generated and expenditure to be incurred. So what is the income to be budgeting means what would be the income generation during the year, what would be the expenses incurred during the year, right? So that you have to prepare. Generate and expenditure to be incurred during the period, and the capital to be employed to attain a given objective. So capital employment means asset, your fixed assets, how you are doing your functional activities, right? So this is called budget. Various advantages and disadvantages. Advantages is most one. It gives you the systematic uh, plan and framing the policies and take initiatives, then coordination, controlling, supporting. So all these things are very important advantages. So what are the types of budgets? There are various types of budgets are there. Budgets we can classify under functional budget, flexibility budget, under time consumption. Under functional budget, we can divide sales, production, raw material, purchases, labor, production overhead, selling overhead, administration overhead. These are all the budgets prepared based upon the functional activities. Flexibility, that is fixed. There are two types: fixed budget and flexible budget. So flexible budget means if you are producing 80% level of capacity, so what would be the expected level of 100% of level of capacity? If you are preparing the 60% of level of capacity at present is going on, so you have to estimate 80%, 70%, 90%, or 100%, like that. That is called flexibility budget, flexible budget. Then time, based upon time, long term budget, short term budget, current budget, rolling budget. So various types of budgets are prepared. Let us see functional budget, that is sales budget. You know what is the total sales to be made during this year. So you have to quantify based upon the various sales head, marketing team. They have to analyze the demand, forecast the demand in the market. Then what is the previous year sales? So based upon that, you have to estimate the sales, right? So that is called sales budget. Similar way, all the other functional budget you have to estimate. See here, flexibility budget we used to prepare like this. For 60% level of capacity, what is the expenditure? 80% of level of capacity, what is the expenditure? 100% level. So here you have to prepare expenditure. You can divide it into fixed expenditure and variable expenditure. Fixed expenditure means what? The expenditure which is incurred the same amount for any level of capacity. If you are incurring 100 rupees, if you are producing 10 unit or 100 unit or 1000 unit, the same 100 rupees you have to incur. That is called fixed. Direct material, direct labor, direct expenditures are these variable cost. This is direct material, direct labor, and direct expenditure. These are all variable expenditure, vary with the volume of output. Fixed expenditure, that is called factory rent, administrative expenditure. So all these things are fixed expenditure. Some expenditure may be semi fixed. That means what? 50% fixed, 50% flexible. That means 50% of that it will change when your capacity change, right? So you have to prepare. This is the statement we have given, like prime cost sheet statement for how we are preparing prime cost, like that. So prime cost, under that, direct material, direct labor, direct wages. If you add these three, that is prime cost. Then variable overheads, all the other indirect variable, only variable portion you have to take. Maintenance and repairs, indirect labor, indirect material, factory overheads, administrative overheads, selling and distribution, all the variable expenditures you add it. Then next one is that if you add prime cost plus variable overhead, that is called marginal costing. Then plus if you deduct sales, that is contribution. Contribution minus fixed cost, all the other fixed cost, that is called profit or sale, loss. Okay, let us prepare one problem, you can understand. Similar way, cash budget we have to prepare. I tell you one by one. Let us do some problems. See this problem. Prepare a flexible budget for overheads on the basis of following data. Ascertain the overhead rates at 50%, 60%, and 70% capacity. So variable overhead at 60% level of capacity, informations are available, right? So you are required to prepare 50%, 60%, 70%, right? So 50% level of capacity, first when we have to write variable overheads. Direct variable expenditure, what are they? Material and labor. Direct material, how much it is given? You see here, direct material is given 6,000 for 60% of level of capacity. So 6,000 for 60% level. What for 50%? So 6,000 divided by 60% into 50%, that is 5,000. Then similar way, 6,000 divided by 60% into 70%, so 7,000. So variable expenditure vary with the volume of output. You have to calculate according to that, right? See here, a labor similar way, 18,000 for 60% level of capacity. So for level of 60%, 18,000. Now what for 50%? What for 70%? That is 15,000 and 21,000. So this is variable overhead. Now let us come to semi-variable expenditure. So what are the semi-variable expenditure here? Electricity and repair. So electricity you see here, for 40% fixed, 60% variable. Total amount is 30,000. You have to take it fixed separately and variable separately. Okay. So electricity, if you are taking 30,000, you take 60%, how much it comes? You can use your calculator. Hmm. 30,000 divided by, into 60%. 18,000, right? So 18,000 is variable portion, electricity. So under 60% level of capacity, you write it here. This is this 30,000. How you got it? Same thing, right? This 30,000 is 18,000 is variable portion plus 12,000 fixed portion. Okay. Now this 18,000, now we have to take for 18,000 60% means what for 50%. 18,000 divided by 60% into 50%. 15,000. So 15,000 plus fixed expenditure same 12,000. So 15 plus 12, 27,000. So here 18,000 divided by 60% into 70% capacity, 21,000. So 21,000 plus 12,000. So how much it is? 21 plus 12, 33,000. So total 33,000 for electricity. Similar way, you have to calculate repairs. Repairs is given 80% fixed, 20% variable. So 3,000 into 80%. So 2,400 is fixed. Okay. Remaining 600 is variable plus 2,400 fixed. So 600 for 60% means what for 70%, 50% and 70%. 600 divided by 60% into 50%. So 500. So 500 plus 2,400, 2,900, right? So here 700 plus 2,400, 3,900. So semi-variable expenditure, you have to be very careful. You have to take out fixed expenditure separately and variable expenditure separately. Only variable expenditure vary with the volume of output that you have to calculate, and fixed portion you total it. That is semi-variable expenditure. Fixed expenditure, whatever it is given, it is applicable same for all, any level of activity, right? So depreciation, insurance, salary, these are all total overheads. These are all comes under total overheads will be different. Only these three items are fixed expenditure, remain the same in all level of capacity. Now you total the total overheads under 60% level of capacity, you will get it 93,000. But you see here if you total it at 50% level of capacity, it is 85,900. Under 70% level of capacity, it is 1 lakh 100. Right now, estimated direct labor hours are given. So you have to calculate labor rate also. So labor rate means what? What is the total expenditure or total overhead expenditure incurred during the year divided by estimated direct labor hour. So 85,900 divided by 1,55,000, that is overhead rate 55 paise, and under 50% level of capacity. Under 60% level of capacity, it is 50 paise. Under 70% level of capacity, it is 46 paise. See here, labor hour also will be vary with the capacity. Under 60% level of capacity, it is 1,86,000. What for 50%? What for 70%? If you are calculating what for 50%, that is 1,55,000 hours. If you are calculating 70% level of capacity, it is 2,17,000 hours. Okay. You understand this flexible budget? Yes. Anybody? Do you have any question?
Yes, ma'am.
Can we go next one?
Yeah, ma'am.
Okay. You see the next one. See here. The expenses budget for production 1000 units in a factory are furnished below. Prepare budget for production 600 units and 800 units, assuming administrative expenses are rigid for all level of production. Rigid means what? Fixed expenditure. Administrative expenditure is called fixed expenditure. See here, you have to prepare budget for 700. Material cost is given 700, 1000 units. Expenses budget for production of 1000 units in a factory are furnished. So for 1000 units, if you are producing, the expenditures are estimated expenditures are given. So you are required to prepare budget for 600 and 800. Okay, so 1000 units you have to take up. So 1000 rupees, 1000 units of production if you are making, material cost will be 700. Okay, so in that case, you have to calculate per unit cost is given. So 1000 units, you have to take 600 units and 800 units. So material cost 700 into 600, that is 4 lakhs 20,000. Where labor 250 into 600, 1 lakh 50,000. Variable overheads 200 into 600. So 1 lakh 20,000. Similar way, you have to calculate for 800 units. So 800 units, if you are calculating 700 into 800. So here something is missing. 700 into 800. 5,60,000. Okay. So now variable total variable overheads are 6,90,000 and 9,20,000. Next one, semi variable expenditure. So what are they? Selling expenditure is given 20% fixed. That means what? 20 percentage is fixed portion, remaining 80 percentage is variable portion. So 130 into 20 percentage, you take it out separately, fixed portion. So 130 into 20%. So 26 rupees, 26 rupees is fixed portion. Take it out. Remaining 130 minus 136. 130 minus 26. 104 rupees. So 104 rupees is the variable portion. So per unit cost you multiply 104 into 600, 62,400. So 104 into 800 units, that is 83,200. Fixed portion you have to calculate, that is 26 rupees we have calculated. So 26 rupees into 1000 units. Okay, so 26,000 is fixed, that remains constant. So 26,000, 26,000. Total amount of fixed expenditure remains constant. But when you are calculating per unit, it will be vary. Right? 26,000 divided by 600 units, that is 43.33. So 26,000 divided by 800 units, it is 32.50. Right? So total semi-variable expenditure. Administrative expenditure is rigid. That means fixed expenditure. So total administrative expenditure, how much it is given? Totally it is 2 lakhs, or 200 into 1000 units, it is 2 lakhs. 2 lakhs for fixed, for six, even if you are producing 600 units or 800 units or 1000 units, whatever it is 2 lakhs. When you are calculating per unit, it will be changed. Right? So 2 lakhs divided by 600 units, 333.33. 2 lakhs divided by 800 units, that is 250 units. Okay, so now you make the total under 600 unit, 800 units. Under 600 unit, this is the unit cost, this is total cost. Right? This is flexible budget you have to prepare. The next one, this is cash budget. Cash budget, you have to estimate what is the cash, 3 months or 6 months or 5 months, whatever it is. You have to prepare what is the cash position at the end of the month. You have to calculate. So you have to estimate.
Excuse me, ma'am.
Yes, ma'am.
Ma'am, in the previous sum, how did we get the 2 lakh?
It is given administrative expenditure.
Oh, okay.
Within bracket, it is 2 lakhs. Per unit cost is 200 is given.
Okay.
1000 units, 200 into 1000, 2 lakhs.
Yeah.
Even though if it is bracket, if it is not given, you have to calculate like this.
Yeah, okay. Got it, ma'am. Thank you.
Under cash budget, the revenues items and expenditure items are given. See here, from June to December, 6 months revenues and expenditure. What are the revenue? Sales only are revenue. Sales are given. Purchases, wages, manufacturing expenditure, office expenditure, selling expenditures are given. You have to estimate what is the cash in hand at the end of the month. Every month, what is the cash balance? Previous month closing balance will be the opening cash balance of the next month, right? Like that. So according to their instruction, we have to prepare. So you have to prepare budget for August to October. Here budget period is given. You have to read it very carefully. The problem, you have to prepare budget for August to. Even though informations are given from June, you are required to prepare from August to June. August, September, October. Only 3 months you have to prepare. Okay, only 3 months budget you have to prepare, right? See here, cash on hand, 1/8 August, first date, the cash in hand, 25,000 cash balance, right? So next sales, 50% credit sales are realized in the month following the sale, and the remaining 50% in the second month following. That means what? July month sale, 50% you are collecting money next month, August. So 1,92,000, 50% you will collect in the month of August. Remaining 50% you will collect in the month of September. Right? So for August month revenue, how will you get it? 50% from June month and 50% from July month, isn't it? So June month 50%, that is you will collect in the month of July. Remaining 50% you will collect in the month of August. July month 50% you will collect in August and 50% collect in September, right? So you have to be prepare some working sheet, that 50 percentage how it has to come. See here. See, first you have to prepare budget, cash budget, August, September, October. First you have to make a column, receipts and payments. Receipts you have to start with opening balance, 25,000 is given your problem. Then sales you have to estimate, right? Sales, how you have to estimate, separate workings you have to prepare. See here, this table I have given here. August, September, October. 3 months sales revenue we have to estimate. August month, how you get collected? June month 50% and July month 50% you will collect it. So 90,000, 96,000. So 1,86,000 you have to write it in the month of August. So now this is the total receipt you got it. Now you have to make the payment of purchases. Purchases, what they are saying, let us see. Creditors are paid in the month following the month of purchases. That means what? 1 month time duration is given, right? So July month what you have purchased, that you have to pay in the month of August. August month what you have purchased, that you have to pay in the month of September. So payables, when you are paying, making payment, that you will be taken into account, right? So purchases you have to take July month for August, August month for September, like that. So 1,44,000, 2 lakhs. Likewise, see here, 1,44,000, 2,43,000, 2,46,000. Okay. Similarly, wages. Wages, what is given? Lag in payment of manufacturing expenses half month, and lag in payment of other expenditures 1 month. See here, manufacturing expenditures are given. Wages is nothing given, no? Manufacturing expenses half month. The other payment of expenditure 1 month. Okay, so wages, let us assume this one. Other expenditures taken 1 month. So wages also let us take. July month wages payable in the month of August. August month wages we are paying in the month of September, like that. So 14,000, 11,000, 12,000. Then office expenditure also you have to take like that. 1,000, 1,500, 2,000. 4,000, 2,000, 5,000. But here only manufacturing expenses 50 percentage. So half month. So half month how we have to pay? July month half and August month half. In the month itself, see here, lag in payment in other, sorry, manufacturing expenses half month. That means what? August month, if you are incurring 3,000, 1,500 you have to pay in the month itself. Remaining 1,500 you can pay next month. Okay. So that means what? Previous month half 2,000 plus current month 1,500. So 3,500 you have to pay in the month of August. Right? Do you understand here? I have given workings here. See here. August month manufacturing expenses, July month half, August month half. For September, August month half and September month half. Then for October, September month half and then October month half. So now you make the total and write it in the manufacturing expenses. Now you make the total of first August month, total payments. Total receipts column, total it, and total payments column, you total it. Now you have to deduct it. What is the net balance? Receipts minus payments. If you have a positive balance, that is closing cash balance. This closing cash balance will be the opening cash balance for the next month. Right? So 44,500 is the closing cash balance of August month. Will be the opening cash balance of September. right? So that we have to put it, and then now you have to make the total. And in the September month, you are getting in negative figure. That means what? Budget, you have to make, that means you have to make arrangement for cash, or so you can say uh, bank, you have to arrange bank loan, something. Okay. So 66,750 is the negative balance. Even though if it is negative, you have to take it as a opening cash balance in the month of October. So total closing cash balance is minus 1,95,500. This is the cash budget. Okay. Do you understand, ma? Can we go for next one?
Okay, ma'am.
Okay. Say this problem. SK Brothers wish to approach the bankers for temporary overdraft facility for the period from October 2010 to December 2010. During the period of these 3 months, the firm will be manufacturing mostly for stock. You are required to prepare cash budget, and 50% credit sales are realized in the month following. The sales remaining 50% in the second month following. Creditors are paid in the month following month purchases, and the estimated cash is 50,000. Same, similar like previous problem. You have to prepare 3 months budget: October, November, December. Here from August you have information from August. So October, November, December, this 3 months you have to prepare budget. Receipts, first opening cash balance is given in your problem, 50,000. Then cash collection from debtor, that is 50% from the, see here workings I have made here, 50% from the next month, and second 50% in the second month. So for us, when we is required October, no? Right? October month collection, you will get August month 50% and September month 50%, isn't it? August and September 50% you have to collect in the month of October. November, September and October 50% you are collecting. And for December, September and October, sorry, October and November. October and November 50% you are collecting. So cash collection from debtor, we have calculated separately in workings, that is 3 lakhs 72,000, 3 lakhs 2 lakhs 82,000. Right. So now you make the total of total receipts. Then here payments we have to write it. Payments, creditors are following the month are given. So following the month, see purchases. For October month, you have to take September month. So 2 lakhs 88,000, 4 lakhs 86,000, and 4 lakhs 92,000. Okay. So wages you have to take 1 month. Generally, 1 month we used to take. Okay. Anything is given for wages. Purchases only are given, right? If nothing is given, the wages you have to pay the current month expenditure itself. See here, wages October, November, December. So 22,000, 20,000 and 30,000, because nothing information is given. So that means we are implied meaning is the concerned month expenditure you have to put it in that column. Okay, so 22, 20, 30. Now you make the total payments. find out what is the closing cash balance for the month of October. That will be the opening cash balance. You have to write it here. So uh, find out what is the closing cash balance for November and close this account December. What is the total closing cash balance? That's all with regards to this. Okay. Similar way, cash budget, one more problem I have made it here. You try to practice it. Okay. Next one, let us go for standard costing and variance analysis. Standard costing and variance analysis you have studied already in accounting for manager while studying. Variance analysis, raw material and labor you have studied, right? So here you have to study in addition to that sales variances as well as overhead variances also you have to study. So you have to 12 மணி you have to see the standard costing and standard costing I already told you, that is predetermined cost. So you have to determine how much it would be. That is budgetary. You have to determine how, if you want to produce 1 unit of output, what would be the raw material incurred, what would be the labor, like that. So total expenditure, how much it is. Now when your actual expenditure incurred, you have to compare with that whether that actual expenditure is more or less. So is it advantageous or disadvantageous, favorable or unfavorable? That you have to find out, and this is a controlling tool or technique for cost controlling method, and also taking decision making and find out why, what is the reason it is actual expenditure is beyond what we have expected. So many decisions will be taken based upon this. There are various formulas I have given here. You have to go through each and every formula here, not possible to explain. Already have studied these formulas. Direct material variances, that is material cost variance, price variance, usage variance, yield variance, mix variance. Material cost variance, you have to take up standard cost based on actual output. You have to calculate based on actual output how much it would be, like that. Then minus actual cost you have to take out, right? So similar way, yield variance also there. Then material labor variances, and then sales variance, fixed overhead variance, variable overhead variance. All variances are in your syllabus, so you have to go through and practice all the problems, right? Let us do one problem in material cost variances. See here. I think these are the problems already we have done in first semester itself. Anyway, let us do one or two problem. See here, a manufacturing concern which has adopted standard costing furnished the following information. Standard material for 70 kg finished product, 100 kg price of material, rupee 1 per kg. Actual output, it is 2 lakhs 10,000 kg. Materials used 2 lakhs 80,000 kg. Cost of material 2 lakhs 52,000. Calculate material usage variance, price variance, and cost variance, right? So now first of all you have to find out material cost variance. When you are calculating standard quantity based on actual output, you have to take out, right? So what is the output is given? Standard material 70 kg finished product, if you want to produce 100 kg of raw material is required. Do you understand? 70 kg finished product, if you want standard output, 70 kg is the output. 70 kg of output, if you are required, how many units are required? 100 kgs are required. So standard quantity you have to take it out actual based on actual output. Actual output is what is given in your problem. 2 lakhs 10,000 is given, right? So 2 lakhs 10,000 for 70 kg of raw material, you are producing 2,10,000. What for? 100 kg. So you can find out total units, materials, how many kgs are required. 3 lakhs kg. Standard material, how much is required? 3 lakhs kgs. These are all first workings you have to find out, right? Then actual price per unit you have to calculate. See here, actual price is 2,52,000 is given. Material cost 2,80,000. Material usage is given. See here, material used 2,80,000. Material cost is 2,52,000. So per unit of actual rate is 90 paise. 252 by 2,80,000 is 90 paise. Now let us prepare this formula. Material cost variance. Material cost variance is equal to what? Standard cost minus actual cost. Standard cost means what? Standard quantity based on actual output into standard rate. That is standard cost, right? So standard cost, standard quantity based on actual output, we have already calculated. That is 3 lakhs. 3 lakhs into standard rate is 1 rupee. Standard rate, how you got 1 rupee? See here, it is given in your problem. Price of material 1 rupee, right? So 3 lakhs into 1 rupee. Actual quantity, how much you have used for production? 2,80,000 kg. So 2,80,000 into 90 paise per unit, right? Already we have calculated. So this is the standard cost is 3 lakhs minus actual cost is 2,52,000. So is it favorable or unfavorable?
Favorable.
Favorable, because we are estimating it is 3 lakhs, but actually we have incurred only 2,52,000. So 48,000 is favorable. Now you come to the material price variance. Material price variance, what is the formula? Actual quantity into standard price minus actual price. Actual quantity, what you have calculated? Actual quantity is 2,80,000 into 1 minus 90 paise. Standard price is 1 rupee, actual price is 90 paise, right? So price variance is 28,000. Is it favorable or unfavorable? Actual is 890 paise. It is lesser than your estimated. Estimated is 1 rupee. So it is favorable. 28,000 favorable. Similar way, material usage variance you have to calculate. Material usage variance, what is the formula? Standard rate into standard quantity for actual output. So standard rate we have already calculated, that is 1 rupee is given into standard quantity based on actual output, that is 3 lakhs minus actual output is 2 lakhs 80,000. So 20th actual unit, is it how it is favorable? Material usage variance. Raw material, actually we are estimating 3 lakhs units are required, kgs are required, but actually we have utilized only 2 lakhs 80,000 kg of raw material. So we have utilized lesser than the estimated, so it is favorable, right? So you can verify material cost variance is due to price variance and usage variance. Cost variance is 48,000 favorable is equal to, how it is? Price variance is 28,000 favorable plus 20,000 usage variance is favorable, right? This is the way of verification whether you have done it correct or not. This is the material variances. Material variances, in addition to that, mix variance and yield variance. When you are going for 2-3 types of material, raw material, in that case, you have to go for mix variance, material mix variance, and then yield variance. All these things you have to calculate, right? See here, this problem I have given material mix variance, because here material A, B, C, 3 types of materials we have used it here. So mix variance you have to calculate, mix variance and then yield variance. For calculating mix variance, we have to calculate revised standard quantity. Shall we do this problem right now? Yes. See here. Material A, B, C, 60 units, 80 units, 100 units. If you want to produce standard mixes to produce of 1 unit of output, if you want to produce 1 unit of output, 240 units of ABC, that combo is required, right? 1 unit of output if you want to produce, material A 60 unit, material B is 80 units, material C 100 units. A total combo 240 units are required to produce 1 unit of output. This is a standard one. Okay, actual it is given. How much is given? Material C, this is actual given. Material A 640 units, material B 950 units, material C this much is used. 2460 units totally. This is total, right? So actual production, how many units you have produced? 10 units. See here. April, in the month of April, 10 units were actually produced. For 10 units, you have incurred 2,460 units you have utilized, right? So let us calculate. First, we have to calculate standard quantity based on actual output we have to take out. Okay. Actual output is 10 unit, right? So 10 unit, how much is required? See here, material A, our combo is 60 for 1 unit. What for 10 unit? 600 unit. What for 10 unit? 800 units. What for 10 unit? 1000 units. So 10 unit of output if you want to produce, what is your budget? Standard quantity is 2400 units are required. This is the standard one. Standard quantity based on actual output. Okay. So actual output for 10 units, it is given. No need to calculate, it is already given, you calculate it. Okay, let us do the equation. Material cost variance, what is the formula? Standard cost minus actual cost. Standard cost, we have calculated standard quantity based on actual output into standard rate. Already we have calculated, this is the total amount. Standard cost is 50,000 minus 52 actual cost is 52,225. So it is adverse. Why? Because actual cost is greater than your standard cost. So 2,225. That is the material cost variance. Okay, next one, material price variance. Material price variance, what is the formula? Standard price minus actual price into actual quantity. So standard price you have to take out. What is the standard price? 15 rupees, 20 rupees, 25 rupees. Already it is given in your problem. Standard price minus actual price, we have given here 1750, this one, right? Actual quantity we have given here. Actual quantity 640, 950, 870. If you are calculating material price variances individually, you have to take out adverse or favorable. Net effect also you have to find out what is the net effect. Suppose here, see here, 1600 adverse, 2175 adverse. Add these two, deduct favorable. So 3775 minus 1900. So net effect is 1875 is the adverse, right? So net effect you have to take. Next one, material usage variance. Material usage variance, what is the formula? Standard quantity minus actual quantity into standard price. Standard price already we have given here in problem 15, 20, 25. Standard quantity we have calculated here 600, 800,000. This one 640, same thing, right? So material usage variance is 350 adverse net effect. This is as usual, right? So come to the mix variance. Material mix variance, what is the formula? When you are mixing two types or three types of material, we have to write the formula revised standard quantity minus actual quantity into standard price. This is the formula. Okay. So revised standard quantity, how you have to calculate? See here, revised standard quantity we have calculated here. That is total actual number of units incurred for production of 10 units, right? So 2000 actual actual how many units incurred? 2460 actual total. Standard total is 2400. Okay, so now you see, for 2400 units you are actually you have spent 2460, right? So what for 600? 600 means that is standard material you have used, right? See here, standard material individually you have to take 600, 800, 2400, right? So for 2400 units, you are using 600 units, right? Total amount of quantity is 2400. Out of it, 600 units standard you have fixed. What for 2460? So see, for 60 units, what is its proportion? That proportion you have to calculate, that is 615 units. Similar way, 2460 into 800 divided by 2400. Here into 1000 divided by this one. So when you are calculating, revised standard quantity is 615 unit, 820 unit, 1025 units. Okay, these are the things you have to calculate. So now you come here, per material A, revised standard quantity minus actual quantity. Revised standard quantity is 615 minus 640 into standard price. So if you are calculating whether is it adverse or favorable. So material mix variance net effect is 900 favorable. Similar way, material yield variance you have to calculate. Material yield variance, what is the formula? Actual yield minus standard yield into standard output price. Actual yield, how much it is? Actual yield we have given in the problem 10 units. Actual yield. Standard yield we do not know. We have to calculate standard yield. Standard yield you have to calculate based upon the what is the raw material actually you have incurred to the production. Actual unit, how much you have incurred for the production? 2460 unit kg, isn't it? So 2460 unit you are producing for how many? See here, 2460 units you are producing, that is for 10 units of output. So standard is how much? For 1 unit of output, how many units are only required? 240 units only are required, right? So 2460 divided by 240 unit, then you can find out what is the actual yield you have to be incurred, right? So 2460 divided by 240, 10.25 unit, right? So yield, that is into standard output price. Output price, how you have to take? Output price is 5000. See here, 1 unit of you are producing output, that is this is the combo. Standard output price is 5000 total amount, 1 unit. Okay, so 10 minus 10.25 into 5000, this is this material yield variance. Okay, now you can verify two formula. One thing is material cost variance. See here, material cost variance is due to price variance and usage variance. Material cost variance is 2225 adverse is equal to material price variance 1875 adverse plus material usage variance 350 adverse, right? So if you make this two adverse total, it will be equal. Now this material usage variance, now let us take material usage variance is due to material mix variance and yield variance, right? So material usage variance is how much we have taken here? uh, 350 adverse, right? Usage variance. So 350 adverse, we can take it out. And material mix variance, how much you have calculated? 900 favorable plus yield variance is 1250 adverse, right? So either you can take it like this, or material cost variance is equal to material price variance plus either material usage variance or mix variance and yield variance. You have to understand, material usage variance is due to mix variance and yield variance. That's it. That you have to understand. Okay. Do you understand, ma?
Okay, ma'am.
Similar way, you see here labor variances. Labor variances I have given full of formula and problems also, and then overhead variable expenditure, fixed and variable overhead, sales variances. These are all formulas only. You have to go through, you have to by heart, no other go, and then understand and by heart. Otherwise it will be very tough, so you have to practice many problems. So you practice it many things, then next class we will go next chapter, because only we have 6 hours. Within that we have to complete all these things. So these are the formulas, you have to go through that and then you have to practice it. You practice it. If you have any doubt, I will explain you in the last class. Okay. Okay, let us wind up this class. Next person will come.
Yes, good afternoon, students. Yes, am I audible, pa? Is my screen is visible to you?
Yes, sir.
Okay. Right. So we start unit number 2, pa. Okay. So we are discussing on in strategic financial management, unit number 2 now. Okay. So in this, we are going to discuss on how the investment decision is going to be taken when we are going to incorporate. There are two addition, pa, that is risk and uncertainty. Another one is statistical distribution approach. In that time, we are going to take a investment decision. Okay, wow. So we all studied in the financial management itself. So whenever you are looking for any investment, you supposed to consider the benefit and the cost, right? So it was normally, right? So whenever we are looking for any investment, so we used to compare what is the benefit we are going to receive from the particular investment and what are the costs associated with that investment. So we used to measure and based on our result, maybe if it is benefit is above our cost or maybe above our expectation, we used to upset that project. So that is what we used to do in our in financial management. Okay, wow. Same we are going to incorporate, but thing is that we are going to incorporate risk analysis also, right? So we are going to incorporate certainty approach, or we are going to use a decision tree approach, or we are going to use maybe some technique like a we call it as a what you call statistical distribution approach. These are the approach we are going to use to evaluate particular investment. This is helping you to find a better capital budgeting decision. Okay. So that is what we are going to discuss. And we all know any project, if you are going to take it, it is going to have a four source of a risk. The first source of risk is we call it as an I, that is size of the project or size of the investment. If the size of the investments are keep increasing and the risk also is increasing. Let me take like this, but there are two projects you are going to evaluate. Project A, the cost is 1 crore rupee. Project A cost is some 10 lakh rupee. Okay. So whenever you are looking for an high value of investment, the risk also will be very high because if that investment is lost, okay, if that investment you taken a wrong investment in, you may lose your entire capital also. So this may be mean other way also. So the business has to be closed. There is no other way because you lost your capital. In that way also it will be happen if the investments are, if the size of investments is very high. The second one is, and we need to consider an hypothetically two situations. But here there are given two advertisements, sorry, two type of things they given. Whether company should upset a project that offer a 20% return for 2 years. That is the first condition. That is first project is giving 20% for a period of 2 years. And another investment giving you 60% for a period of 3 years. And we need to check whether which investment has to be taken for your investment proposal. Okay. The first investment 20 into 2 years. The second investment is 16 into 3 years. And we need to take it no. So if you are in the investment analysis, we used to refer in the first investment only. The reason is in the first 2 years, you are able to receive 40% of the return. But what? There is no guarantee for the third year. Okay. So if it is investment point of view, we need to think from the how far the investment are able to give a better return. Third year, you may get 16%. And what is the guarantee that you are going to get a third year? It is a compulsion. There is no compulsion. No, you may get 10%, 12%. It may get even 18% also. But there is no guarantee for the third year. Okay, that is why we need to think from the how early the investment is going to give a benefit for us. Late benefit is not going to be considered if it is an investment, because you are going to have a time value of the money also. And again, it is very difficult to calculate a cash flows. Okay, if you are investing and particular investment, there is no guarantee that this much only you may get a return from a company, a particular things. Okay, it is not practically possible. So you may forecast a cash flow of a particular investment, not exactly. There will be some error will be there, and that is why you may have a risk also. The fourth one is the life of the project. Again, it was very difficult to determine the life of the project precisely. Assume that I'm purchasing a car. Can you tell me how many years I can ride the car without any major expenditure? It is depends, no? Somebody will say that you can run a car with the 5 years without any major expenditure. Somebody may say that 7 years. Somebody may say that it may go to even 10 years. Somebody may say that it's 2 to 3 years also. It is depends, no? So we cannot determine the life of the project same way. Okay. So sometimes the project will give you the profit for the 5 year or 10 year. It depends. So we cannot calculate the life of the project precisely. So we can calculate roughly, but not exactly. Okay, wow. So with this, we have a two type of risk we have. One is company owner point of view, that we call it as a shareholder point of view. Another one is company's perspective. Okay. So in that way, then we are going to understand the company's risk part. Okay. So with this, I was moving on to the risk, that is capital budgeting. Only we are going to evaluate. In that, we are going to incorporate the risk into the capital budget. Okay. Maybe in the financial management, you may be studied a certain items without incorporating a risk. But we are incorporating a risk to evaluate the capital budgeting. Okay. So in the financial management, you may be studied like this. Let me. If it is in a financial management, you may be studied. The techniques will be in two categories, right? The first category is we called as a traditional technique. The second category will be called as a modern technique. Okay. Or the traditional technique will be known as the non-discounted technique. Modern techniques will be called as a discounted cash flow technique. Right? In the non-discounted, we have like a payback period method. We may have a ARR method, that is average rate of return or accounting rate of return. Whereas in the discounting techniques, we may have a NPV, right? Net present value. We have a profitability index. We have IRR, that is internal rate of return. So like this, there are various methods we have in the capital budgeting decision, right? So capital budgeting can be done in two ways. One is traditional way. There we are not considering time value. That is known as the non-discounted technique. In some other method, we have time value also, right? So the time value adjusted is, these are all time adjusted things. Okay, so modern techniques, NPV, IRR, power index. Okay, so whereas in the traditional model and modern model, we are not incorporating the risk of the project. Okay, in the financial management. Now we are going to incorporate what are the risks the company is going to face. What are the risks the investment is going to face. We are going to incorporate the risk to evaluate the capital budgeting, to evaluate the particular investment. Clear up? In that way, we are going for evaluation. Okay. So with this, we are going to discuss about the first approach. That approach is known as the certainty equivalent approach. Okay. Under this approach, we are going to calculate an investment proposal by certainty basis. Certainty is nothing but what is the guarantee that you are going to get a return. Okay. So it is nothing but out of 100%. And what is the guarantee that you are going to get the 10%, 10,000 rupee. So we are going to incorporate the guaranteed amount, or we call it as a certainty amount. So that will be called as certainty equivalent approach. Okay. So we can go to the straight away the problem actually. So here, this is the certainty equivalent coefficients is given for in a particular investment, and they are given year one. The replacement investment is how much by? It was given by 0.92. Year 2, it was 0.87. It was given like this by year wise. Same way, expansion of investment, what is the equivalent of coefficient? What is the new investment? The coefficient is given. Same way, the R&D of the coefficient is also given. So with this, we are going to calculate, and what is the guarantee that we are going to get a return. Okay. So we'll discuss example number 1. Listen carefully. Yes, you are able to follow me, Appa. So can I discuss the illustration 1 now? Is it visible? So can I discuss this?
Yes, sir.
Okay. Listen here. A firm with a 10% required rate of return is considering building a new research facilities with the expected life of 5 years. So the firm is wanted to check a research proposal, and they have a cut-off rate is 10%. Okay. And it's considering a new proposal. And the cash flow is given for 1,20,000 rupee. That is, initially they are going to make a payment of 1,20,000 rupee. That is outflow. How much they are paying to get a cash inflows? 1,20,000 they are paying. The expected cash inflows and the certainty equivalent coefficient is given. The first year, second year, and third year, and fourth year. Like this, it is given. So we are going to calculate. They say the 10,000 will may get in the first year, 20,000 in the third year, 40,000 in the third year, and 80,000 in the fourth year, and 80,000 in the fifth year. And they are also given the certainty value. So we are going to multiply these two by that is 10,000 we may expect in the first year, and the chances for getting in 10,000 is just 95%. That we can say that 0.9%. Same way, 20,000 you may expect in the second year, and the chances for getting is just 90%. So with this, we are going to multiply, and we are going to arrive the certainty equivalent cash flow. Okay. First year, you may expect 10,000. The chances for getting 10,000 is just less, and we have taken that 10,000 or 9,500. Okay. So this is known as the certainty equivalent cash flows. Original cash flow is 10,000. Certainty equivalent cash flows is 9,500. Same way, 20,000 multiplied by 0.90 will be, you may get a 18,000. Same way, 40,000 multiplied by 0.85, you may get a 34,000. So this 34, 18,000, 9,500, 60,000, 52,000, these will be called as a expected cash flow after adjusting the risk. Okay, because if it is in a financial management, we'll take it as it is for 10,000, 20,000, or 40 like this. But whereas in the equivalent approach or certain equivalent approach, we are adjusting the risk. Okay, here 95% only we are able to get a money from our original value. So that is why we take a 95% of the 10,000. 90% of the 20,000, 85% of the 40,000, 75% of the 80,000, and last year 80,000 of 65%. Okay, in that way we calculating. That is our expected cash flow, or we known as the certainty equivalent cash flow. For that, we are going to arrive a methodology path. Okay, so for that we are going to have time value of the money. Okay. So the time value of the money, we are going to arrive just a minute. I think my calculator will be visible to you. Just a minute. Okay. So we are going to calculate 9,500 in the first year cash inflows. At 6% we are assuming. It is depends. Sometimes they may given a risk-free rate, or you can take a 6% or 8%, depending on the situation. So here they are taken a 6%. 6% is nothing but every year the money is losing its value by 6%. Okay. So that is why we are going to take a 6% as a return. So okay. So how we can calculate the 6%? So note down the formula. That is, we can take like this: 1 divided by 1 plus r power n will give you the 6% value of a reduction. Okay. 1 divided by 1 plus r power the n will give you the 6% value. Okay, same formula I'm going to apply here. 1 divided by 1 plus r. As of this exam is going to 6%, 1 divided by 1.06, because 6% means 0.6. 1 plus 0.6. So 1.06. Since power n will be the same value, I was given like this. What is the amount we are able to get? 0.943. Okay, what is the 0.943 power? That is nothing but 1 year value. By the end of the year, it has become 94 paise. Okay. Same way for the second year, 1 divided by 1.106, that is 1.06, power 2, power 3, power 4, power 5. Like this, we are going to calculate for the different year. You are able to follow me up? So this is nothing but 1 rupee value we calculating for the year end. Same we can adapt to in the second year mean I'm going to use it like this: 1 divided by 1.06 power 2. That is this value 0.890. For the third year, 1 divided by 1.06 power 3. That value is 0.840. Same way for the fourth year, 1 divided by 1.06 power 4. That value is 0.792. Same way we calculating 1 rupee value. Again, we need to understand the time value of the money very clearly. Okay. Because we are going to invest today, and the expected cash flow we are going to receive after 1 year, after 2 years, after 3 years. But investments made are under 0 period. Now, today I'm making an investment. 1 year later, you are going to get a 9,500 rupee. 2 years later, you are going to get a 8,000 rupee. 3 years later, you are going to get a 34,000 rupee. Fourth year, you are going to get a 60,000 rupee. Fifth year, you are going to get a 52,000. This is not equal value, no, because again, we know that 2023, if you have 1 lakh rupee, that is not equal to 2024 1 lakh rupee. That all you agree, no? The time value of the money is the deciding factor. Same way, 1987, I have a 1 lakh rupee. Do you think that that same 1 lakh rupee which you have currently is same value? 2024 of 1 lakh rupee, is it equal to 1987 of 1 lakh rupee? No, because the reason is the purchasing power of the money will be different. Let me take it like this. In the year of 1987, 1 gram of gold equal to just 200 rupee. So with 1 lakh rupee, I may be able to buy how many gram? Almost 50 gram of gold I am able to buy in 1987, because 1 gram gold equal to just 200 rupee. But now 1 gram of gold equal to 7,500 rupee. How much I can buy roughly? So I may buy roughly some 13 gram gold. Same 1 lakh rupee, you are comparing 1987, you are able to buy 50 gram. Now you are able to buy only 13 gram. The reason is, what is the reason? So the purchasing power of the monies are coming down. That is why the money we are not going to consider as it is. First year end, second year end, third year end, fourth year end, and fifth year end, I'm going to get a receive different money. So I cannot equate all the money into the single scalings. So that is why I'm adjusting at the inflation rate. I'm adjusting at the inflation rate or risk-free rate or any other rate. Okay. So that rate I'm calculating 1 rupee value by today. I'm going to receive 1 year later 1 rupee. That is 94 paise. I'm going to receive 2 years later 1 rupee. That value is 99 paise. Okay. Same way, I'm going to receive 3 years later, I'm going to receive 1 rupee. That value is 84 paisa. Like this, you are calculating 1 rupee value and multiply by these two. Okay. So these two, that is 9,500 rupee I'm going to get. And 1 rupee is 943 mean this is the new value, 8,958. Okay. 16,250. So 18,000 you may get, but today value of the 18,000 is just 16,000 only. You may get a third year 34,000. The today value is 28,560. So like this you arrived and that total you are going to get it. Okay. So 1,20,000, that is what we said as NPV. 1,20,000 I'm making investment by today. Listen carefully. And I may get a 9,500 rupee first year, certainly. The value of the 9,500 is just 8,958. Okay, 8,950. 9,068. Same way, you may get 18,000. That value is just 16,000. You may get a third year, 34,000. That value is just 28,000. Clear up? So like this, you calculating the original value. And that value we are taking for minus 1,20,000 because you are made investment by today. And these are all cash inflows. So cash inflows, I'm going to sum up. That is this total minus 1,20,000 will give you the return. If this amount is positive, I can take an investment. What is amount I'm getting? I'm getting 19,902 as a return. This can be called as a certainty equivalent approach. So I'm adjusting the risk also, the project. The project has a risk. That risk I'm adjusting, this will be called as a certainty equivalent approach. Is it clear, Appa? If this is clear, we'll move on to the next problem, next type of the problem. Same way investment, there is example number 2 is given, Pa. Okay. So the proposal X and Y is given. So in the 0 period, if it is mentioned in a bracket, it is mentioned as a negative value. Okay. There are two proposals, X and Y. X is 40,000 is outflow and Y equal to 10,000 is outflow. And they are given the equivalent coefficient is 1. Also it's nothing but you are going to make complete 100% of the 30,000. Complete 100% of the 40,000. So there is no risk in the cash flow, that is cash outflow. But second year, first year you predicted the 20,000, but the chances for getting 20,000 is just 90%. 18,000 is just 80%. 12,000 is just 80%. Same way, fourth year you are going to get 10,000. The chances is just 60%. Same way for the project Y also is given. So now we are going to calculate like this. Okay. So 40,000 into 1 and you may get a 40,000 and this value equal to same percentage. Again, they are given the risk-free rate 8%. If they are given risk-free rate is 8%, we are going to consider 8%. That's all. The previous problem, they are given a 6% and we are consider 6%. Okay. So we calculating the original value. This is negative value. Okay. This is minus value. 40,000 I'm going to spend. There is no risk in the 40,000. Entire 40,000 I'm going to spend. This is negative 40,000. First year I'm going to get 20,000. The original value of the 20,000 is just 18,000. For the 18,000 I'm going to calculate. Okay. For the 18,000 I'm going to calculate. Just a minute. Hold on. For the 18,000 we are going to calculate. Since they given 18%, sorry, which percentage? 8%, no? So I'll tell you once again how we can calculate 1 divided by 1.08 power 1 for the first year. 1 divided by 1.08 power by 2 for the second year. Like this, we are going to calculate. That values are mentioned here. These are the value mentioned like this 0.8 power 3. I'll show you once again how we can calculate. 1 divided by 1.08 equal to how much? 0.9259. 9259, they convert as a 9260. That's all. Same way, 1 divided by 1.08 x power 1, just a minute. 1 divided by 1.08 power, that is x power 2. What is the amount we are getting? 0.8573. Same it is mentioned here. Same way for the third year also. 1 divided by 0.8 power 3. Third year we calculating. Sorry, I was given 1 divided by 1.08 power 3. 793, 7938. Same money value is given. No? So this is nothing but 1 rupee value. So once you arrived at that, we are going to multiply this to. So that 1 rupee is 1 rupee. So same 9. This is negative 40,000. First year you are going to get 18. And 18 original value is 16,682. So like this you are arriving. And this total, these are all positive amount. And this is the negative amount. And the proposal X is going to give you the profit of 1,043. Okay. The total of this minus 40,000 for the first year, because that is your investment. Okay. Same way, proposal Y also. So proposal Y, we are same way we calculating 30,000 multiplied with 1, same 30,000. And this is first year value, there is no change since we are multiplying with the same 1 rupee. First year end, same amount for 925, 8573, 798. Same thing we are taking from this year, and the corresponding value we multiplying, and that total we are able to get back. Okay. So minus 30,000. So 30,000 I'm able to get a NPV of 1,495. For the 40,000 you are able to get a 1,043. So which is better actually? 1,043 or 1,495? 1,495 is more better, no? Because we are making a 30,000, and with that we are able to make a 1,400 almost. So we are going to take project Y, because NPV is higher in the project Y. Okay, well, same way, this also can be calculated. Yes.
Sir,
Is it clear, Appa? You are able to follow me?
the examination point of
Same
view,
problem.
the examination point of view, this subject is only theory or problem sum.
No, it is combination of theory and problem.
Okay, thank you, sir.
Certain unit you may get a problems.
Okay, sir.
Okay. It is a partially theory, partially problem, but 30% problem you may expect, especially in the unit number 2 and 3. There is a unit 2 and 4 you may get a problem.
Okay,
So
sir.
leasing and this investment proposal you may get a problem.
Okay, sir. Thank you, sir.
Okay. These are the same type of problem, but they are not worked in the tabular column. So they are worked in the some other format, same format. So what I calculated here, no. So instead of this, the PV factor they calculated directly. So in that way also we can work it, but this may lead to confusion. You may get a what we call confusion. That is why it is better to go in a tabular column. Okay, once we are very comfortable in that, we can go in this format also. NPV we can calculate in this way also, but it leads us some expectation. Okay, so these are the same type of problem. You may expect any one problem will this methodology. So cash flow is given, certain equivalent of values also is given, and we need to calculate that also. Now this another forms of problem. Okay. So GVK Limited is considering a two mutually exclusive project, which means that if you are going to take a project A, you can take only project A, not a project B. So any one time you can take any one project. That is called as a mutually exclusive project. Either one has to be taken. Okay. So there were two proposals, project A and the project B. And depends on the condition they are given the cash inflows for both the project A and B, they have a outflow of 5,000 rupees. But whereas the cash inflows, they're given in the three different economic state. One is when the condition is good, project A will give you the 6,000 rupees. Project B will give you the 5,000 rupees. When condition is normal, both the investment is going to give a 4,000, 4,000. When condition is bad, in that time, project A is going to give you 2,000, project B is going to give you 3,000 rupees. Okay. So the discount rate is 7%, and you should be advised which investment has to be taken for the consideration. Again, they are given the probability also. So what is the probability is given? 0.3, 0.4 and 0.3. So when you are adding all the probability, it is going to be 1. Okay. So now we are going to consider probability based cash inflows. We are going to consider nothing, but we are going to multiply with these two. Okay. So there is a chances for getting a 6,000 rupee, and out of 100 or out of 1, there are 0.3% chances there. The condition will be in the good. And the same way, it will be normal will be 0.4, or we'll call it as 40%, and the bad condition will be 0.3 or 30%. Okay, simply we are going to multiply with these two. So 6,000 into 0.3 will be giving you maybe 1,800. Maybe this will be become 1,600, and this will be 1,200. Okay. So 2,000 into 0.3 will be 600 rupees. So that will be mentioned here. They are calculating, simply multiplying 0.3 into 6,000, like this they are calculating, and that will be your project cash flows. Clear up? So 0.3 into 6,000, 0.4 into 4,000, just terminate. Okay. So they are multiplying these two, and this value will become 1,800 and 1,600, and 2 will be 600. Okay. And we are going to calculate the deviation. So deviation is nothing but, and what is the middle value we have? So what is the total of this? All the three? 1,800 plus 1,600 plus 600. The total is 4,000. So the 4,000 they arrived at. And each and every time they're calculating the deviation. What is the deviation? 6,000 minus the mean value. Okay. The first year is you may get a 6,000 rupee, and the deviation is from the mean is nothing but the original value. When you are incorporating the good condition, normal condition, and the bad condition. When good condition is given, you may get a 1800. When the condition is a normal, you may get a 1600. When the condition is very bad, you may get a 600 rupee from the investment. And by adding this, you may get a 4,000 rupee as a normal return by incorporating all the three, good, bad, and the normal. And we have first condition is 6,000 rupee, about 6,000 minus the expectation will give you the deviation, and deviation we are squaring past. Same way, the second one, 4,000 minus 4,000. Third one is 2,000 minus 4,000. So here we are all getting a square. So the first one will become, we have a positive value, no? So 2,000 square. Same way, this will become a 0. The last one will become a 2,000 square. So 2,000 square, 2,000 square, 2 times, it's a 12 lakh, 12 lakh will become a 24 lakh. For the 24 lakh, we are getting a square root. So the deviation is, for the project A is how much? 1,549. That was the deviation of the project A. Same way, project B, we calculating. So we calculating simply for 0.3 into 5,000, you may have 1,500. 0.4 into 4, you may get a 1,600 for second period. And here you may get a 900. So 1,500, 1,600, 900 will become, you may get a 4,000 upper. Same 4,000 you may get it here also. Clear? So 3,100 and 900. So 4,000 you may get it. So first year, the first condition, 5,000 minus 4,000 is 1,000 square, and 0 you may get it here. And here also you will get a 1,000. Okay. And when you comparing this, you may get a lesser deviation. So since both the project is going to be same cash inflows, same cash outflows, but the proposal B is going to give a less deviation. Why it is a less deviation? The reason is here you are able to get a deviation is 776, whereas the project A is going to give a deviation of 1,500 because double time the deviation. Whereas the second one was lesser deviation. Okay, so in that way we are going to take the project X and Y. Okay, so when we have a probability is given, and we need to evaluate the deviation also, how much it is deviating from the original or the mean value or the middle point. So that has to be calculated. Okay, so in that way we can calculate the proposal also. Again, you maybe in a fourth semester, you may have a what we call the derivative and other type of paper. In that time, we called as a risk-free rate of investment. So we are going to consider CAPM model or capital asset pricing model. So there we are going to discuss about like this one. Just a minute. Any investment we are going to consider firstly the risk-free rate of return. Risk-free is nothing but without any risk, you are going to get a return. No, that will be called as a risk-free rate of return. Let me give an example. Say, for example, if you invested in the bank, nowadays bank and all, certainly we can consider as a risk-free return. Or if you are purchasing government securities, maybe government bond, the government may give you some 6% or 7%. So that return will be called as a risk-free return because without any losing of your principal, you may get a 7% return. Okay, because the government is going to pay surely, or the bank is going to make a payment surely. So in that time, the risk-free rate will be called as a certainty amount. 7% means government will give you 7% without any, what do you call it, stoppage, or government will honor you the 7% interest. Okay, but if you are going to make a project A or project B, and in that time, if the project is giving 7% return, and what is the necessity of going with project A? It is not at all necessary, because project A may have a risk. Okay, and you may get only 3% or 4%, depends on the situation. Okay, wow. So we are going by, or we are calculating a project investment by incorporating risk-free rate. If the risk-free rate is 7%, I need to get risk-free rate 7% means plus 4% or 5%. That is what my expectation, because in a without risk also I may get a 5%, 7%. I'm asked to get another 5%, so that only I can take a risk. Or otherwise, I'll go by a normal investment without any risk. Okay. So when you are incorporating risk-free rate in your capital budgeting, it is called as a CAPM model, or we call it as a capital asset pricing model. Okay. So this model also helping you to give you the capital budgeting decision, where we are incorporating the risk-free rate. Okay. And what I'm getting extra will be called as a risk premium. Okay. The risk premium is nothing but risk-free investment is giving a 7%, but I'm getting a premium of 5% because I'm taking a risk. Okay. People who are taking a risk, they may get a risk premium also. Just a minute. Okay. So with this, we are moving into this text. Here, the management of example number 3, page number 92. The management of Pradeepa Limited manufactures our toys in New Delhi and consider the introduction of new type of toy, remote control of motorbike. In the past, management has been quite conservative in the making investment in the new project, and consider this is a quite a risky one. And the management feels that normally used to record rate of return is 10%. Okay, normally they are getting, and 10% is their record rate of return. And since it is a risky project, they are looking for now 16% return. Okay. Since they are taking a risk, that are incorporating 16% of rate of return. If this investment is able to meet 16%, they will take a project. Or otherwise, they may drop the project. That is why we called as risk-free rate plus the premium. They are adding another 6%. The total premium percentage is 16%. 16% the cut-off rate they are going to evaluate. Once the project is able to give above 16%, they are going to consider. Or otherwise, they are not going to consider, because this is a risky project. I need to get extra return. Or otherwise, why should I take a risk and going to get a less return? Okay. So in that way, we are going to work it here. And the year wise, they are given the cash inflows in 1,000 rupee. So first year, they are making a payment of 1,50,000 rupee. And first year end 30,000 rupee for 30,000, 50,000, 60, 40, and 25,000. These are the amount is given as a cash inflows. Okay. So we are going to evaluate now. Same way we are going to calculate. I said that this 1% mean how we can calculate 1 divided by 1.16 upper 1 divided by 1.16. First year, how much value? This has become 0.862. Okay, so they are converting at 8621. Maybe second year, how we can calculate? 1 divided by 1.16, because 16% means 1.60 power 2. 0.7431. Okay, they convert as a 7432. Okay, so like this, they're calculating 16% PV factor value. So that has to be multiplied by 30,000 rupee. 30,000 rupee second year, 50,000 rupee in the third year. Like this, they are multiplying. That total, okay, equal to 1,42,000, and your investment is 1,50,000. So this is your cash inflows. Cash outflows is nothing but how much you are going to make a payment today. 1,50,000. Difference between these two are negative. I am making a payment of 1,50,000. After adjustment of time value of money, I am going to get just 1,42,000. So almost 3,364. I am going to lose. Okay. So in that time, we are not going to upset the project. Okay. If it is 10%, it is okay. But it is not meeting your 16% expectation. So we are not going to consider if the 16% was our expected level. Same way, 10% mean it may give you 20,000, but they arrived in that way, so that we are not going to consider. Okay, so if this is over, we move on to the statistical distribution approach. Is it clear now? Can I go to the second method, unit number 2.2? Yes. So can I go to the example number 4? Yes. Are you following me? Can I start example number 4 now? Page number 95.
Okay, sir.
Yes. Are you following, ma? Anybody is following? So can I
Yes, sir.
start? Okay, okay, but thank you. So we are going to incorporate now the second unit number 2. Okay, statistical distribution approach. The Pradeepa company is considering to make an investment in a proposal which require a outlay of 1,20,000. Okay, so rupees 1,20,000 is required for the investment. Okay, the project has a life of 3 years is given. Okay, which of the following is given the likely to be generated? So first year, second year, third year. First year is 30,000, 40,000. Like this, first year they have cash inflows and the corresponding probability is given. Same way, second year cash inflows and corresponding probability is given. Same way, they are given you the 3-year probability. 3-year cash inflows and the 3-year probability. Okay. So with this, they're asking you to calculate. The management feels that the expected cash flows may be in the various period may be considered into the base to the deduction about the 10%. If the record rate of it is 10%, should the proposal is accepted or not? So we need to answer whether 10% is okay or not. Okay. So in that way, we are going to evaluate. So now we are evaluating proposal like this. The first one is year 1, and same way, since the probability is given for out of 1, 0.2 for there is 20% for the first cash flow, 40% for the second cash flow, 30% for the third cash flow, and the 60% for the last cash flow. So we are going to multiply now. Just a minute. Okay. So first year, 30,000 multiply with 0.2, you may get a 6,000 rupee. So 30,000 you may expect, and chances for getting a 30,000 is just 20% or 0.2 out of 1. So the expected cash flow is equal to just 6,000, not a 30,000. Same way, 40,000 you may expect in the second method, and the chances for getting a 40,000 is 0.4. And if you are multiplying with that, you're getting 16,000 rupee. Okay. Third one is 50,000 you may expect, and the chances of getting 30,000, 50,000 is just 30%. And 50,000 is 0.3 equal to 15,000. Same way, you are multiplying these two, and this total equal to 43,000. This is what expected cash flow for the investment in the first year. Same way for the second year, we are calculating. Okay. So 3,000, 30,000 into 0.1 will be 3,000. 50,000 into 0.4 will be 20,000. 80,000 into 0.4 will be 32,000. So this total equal to 64,000 for the second year. And this total will be, okay, this total will be 66,000. So even though you have various cash inflows for the first year, second year, and third year, and we are incorporating probability-based expected cash inflows for the proposal. One first year 43,000, second year 66,000, third year is 66,000. Okay, 64 and 66,000. Now we are going to evaluate the proposal. Okay, okay. So again, I'm having a 2 o'clock class. So 2 o'clock we continue the same problem. Okay. If at all you have any doubt, let me know. Otherwise, we can start afternoon by 2 o'clock. So up to this, you have any doubt, you can stop me. Otherwise, we can discuss in the 2 o'clock. 2 o'clock, I'm in class. Yes. Okay. So we'll discuss by 2 o'clock.
Thank you, sir.
Okay, but thank you. Good afternoon, students. Am I audible?
Yes, sir.
Okay, okay. Thank you. Okay, so we continue from the problem part. I think before break, we were discussing on that is a statistical distribution approach we started, right? So here, this is the problem we discussing, So the project have a 3 year, that is first year, second year, and 3 year. And each year we have a cash inflows properties is given, right? We simply multiplied that and we got a certainty equivalent cash flow. Okay. That is, I think, about 30,000 into 0.2, we got a 6,000 rupee. Like this, we multiplied the corresponding value, first year value, and that total is 43,000. Second year value, 64,000, and third year value, 66,000. This is what we received first year, second year, and third year. Now we have a certainty equivalent cash flows. So now we are going to take the next process. Okay. In the next process, this is what we had actually. Okay. So now the expected NPV is given like this. And then we are going to calculate. Just a minute. Okay, well. So we said that we spent initially 1,20,000 rupees, that is outflow money. And the first year we arrived 43,000 expected cash flow. Second is 64,000, third year 66,000. And since it is a PV factor at a 10%, we need to calculate the 10% value, right? So once again, I'll show you how we can calculate the 10% value. That is 1 divided by 1.10. 10% means 1.10. You may have 0.09. Okay, so 0.909 is the first year value. That is 1 rupee value will become 1 year later 0.09. Same way, you can calculate for the second year also. So we can calculate 1 divided by 1.10 power 2. 0.8264. So that is what mentioned here upper here. Same way third year also. 1 divided by 1.10 divided by, just a minute, 1 divided by 1.10 power 3. So 7513. Okay, what? So what we calculated, that values are given here. Okay. So that is nothing but first year value. First year end you may get a 1 rupee, that today value. Second year end you may get a 1 rupee, that is today value. And third year end 1 rupee value today, that is 7513. So and then we have to multiply with these two, because 1 rupee value we calculated, and 43,000 into this you may get the current value, but that is 39,031. Same way 64,000, if you are multiplying this, you may get a second year value and third year value. Okay, this total minus the first year 1,20,000, because first 0 period the making an investment, that is minus 1,20,000, and this total, that first year, even though we are receiving 43,000, the value of the money by today value is 39,000. Even though we are receiving 64,000 second year, that value is 52,000 now. Even though we are receiving 66,000 in the third year, the today value equal to just 46,000 only. Okay. So we are at total up in this value, and that value minus 1,20,000 is expected NPV. Okay. Since our NPVs are in a positive, okay, so we can take a decision. Okay. So we can go as long it is above positive value. If it is 0, so we can consider. Positive value also we can consider. But whereas previous problem we discussed, it was negative item. So we spent something and we are receiving negative cash inflows. So that won't be considered here. We spent 1,20,000 rupees, and the today value of the future cash inflows are above 1,20,000. The net difference is 21,566. Okay, so anyway, we are going to have a positive NPV. Okay, so I'll tell you how we can total up also. Just a minute. So how we are going to get 39,091.3 plus 52,889.6 plus 46,585.8. That total equal to 1,38,000. 1,38,567. 566. 1,38,566.7. So difference between 1,20,000, that will be your profit. Okay. So that is what mentioned here. So there is some calculation error. So that total will be your NPV. Okay. So anyway, NPVs are positive. So we can say that the investment can be taken to the consideration. We can invest because our expectation is 10%. It is beating our expectation. So it was above our expectation. Okay. So with this, I was moving to the next item. This is the first one. And then now we are going to calculate the variance of the NPV. So the variance is nothing but same way, certain project you may have some variance. Variance is nothing but how much it is deviating from the calculated value or the original value. Okay. So here, even though we have various cash inflows, right? So 30,000, 40,000, 50,000 and 60,000. What is our original cash inflows? The original cash inflows are only 43,000. Okay. So the expectation is 30,000 and the original value is 43,000. And difference between these two are called as a variation. Okay. How much it is deviating? 30,000 we said, but original is for 43,000. Sometimes we said 60,000 and original is 43,000. Difference between our original and expected values are the variance. So you need to calculate the variance also to understand that the profitability of the firm. Okay. So less variation is better than the more variation, because more variation is nothing but there is a chances for high volatility in your expected cash inflows. Okay. So there are various NPV variance also is there. And with incorporating variance, we have some simulation approach. But simulation is nothing but we are going to simulate a certain model. That model is going to give you the solution for a particular situation. Okay. Simulation is nothing but we are recreating this scenario. For this scenario, how much will be your profit? In that way, we can calculate. Okay. This will be called as a simulation approach. Okay, so for this, we'll have this problem. We can understand this problem. So page number 198. Assume that the financial manager had a pessimistic, most likely, and optimistic estimate. Like this, they have three estimate. One is pessimistic, one is most likely, last one is optimistic. Like this, there are three estimate. Okay, of the cash flow of the each product is given. The cash inflow estimated and resulting in the NPVs is summarized in the following table. Okay. Comparing the range of 1,000 for the project A to 4,000 for the project B. So like this it is given. So we are going to understand. So initial investment for the project A and project B both are same. So 10,000 rupee. Here also 10,000 rupee. There is no change in the initial investment. So outcome is given. Okay, if the pessimistic condition is there, in prevailing in the market, project A may give you the 1,500 rupee as a cash inflow. That is outcome. But whereas project B will not give any profit in the pessimistic condition. When the condition is not good, the project B will not give you any return. But project A will give you the 1,500 rupee. Same way, most likely is nothing but normal time or average time or expected time. Both the project will give you the same return. There is no difference between project A and B. Whereas in a pessimistic condition, there is nothing but, in optimistic condition, when the conditions are very good, okay, when the conditions are very good, the profit of the company, the project A is 2,500 rupees. The cash inflows are 2,500 rupees. Whereas project B will give you the only 4,000 rupees. Okay. So worst condition, no return. When normal condition, both are same. In the worst condition, the project A is giving the normal return. Project B is giving highest return. Okay. So 2,500 rupee, which is given by the project A, and the project B is giving you the 4,000 rupee. Okay, so now we are going to calculate the pessimistic condition and optimistic condition. So what is the range here? So the range is 1,500 to 2,500 rupee. So minimum is 1,500, maximum is 2,500. The range of these negative and positive, that is worst condition and good condition is just a range is 1,000 rupee. Whereas in the project B, when the condition is not good, they are able to give only 0 rupee. Whereas when the condition is very good, they are able to give you 4,000 rupee. The range is 4,000. So now we are going to calculate the cash inflows. Okay. So they are calculating cash inflows. Just a minute. Okay, sorry. Okay, so we comparing the both the project at 10% of the cost of capital and annual cash inflows they are calculating. Okay, so in a pessimistic condition, it was giving you 1409. In a most likely, it able to give you the most in the what they call in the 15 years, 5,212. In the optimist condition, it able to give you the 9,000. It was the printing error. This was a printing error. It was not a 10,000. It was when they copy and pasted, that was given here. Okay. So, and the range is here 7,600 rupees. Here the range is 30,424. So when comparing these two, when the range is very high, the range is nothing but it is going to deviate more. The deviate, that is minimum and the maximum values are difference between these two are very high. Whereas in the project A is the minimum. Okay, just 7,000 rupee was the deviation between the highest value and the lowest value. So we can take the first investment because the range is very less. So in that way also we can take it on a consideration. Okay, so with this we can go to the decision tree approach. Here also you may expect a problem which may come to your exams also sometime. Okay, so listen. So it is example only they are given here. So 0 period, that is nothing but today, investment, the cash outflows are 1 lakh rupee. Okay, and In the first year, the investment may give you the 3 branches or the 3 sub branches. Okay. First year, you have to make a payment of 1 lakh rupee. That is 0 period, you have to make a payment of 1 lakh rupee. First year end, there is a chance for getting a 40,000 is 30% with the probabilities given. Same way, there is a chance for getting a 60,000 at a probability 30%. Okay. At the same time, there is a chances for getting a 70,000 at a probability of 70,000. Okay. Same way, second year. Okay, second year is nothing but when you expected 40,000 in the first branch, that is first year it was happened 40,000 mean the second year you may get a further division of 3 more items. The 40,000 may give you the second year either 60,000 or maybe 70,000 or maybe 80,000. So like this, there are 3 sub branches you may get when you have 40,000 in the first year. Same way for the 60,000 also. So 60,000 you received means second year also you may get a 60,000. 70,000 also you may get at a 0.5% of probability. And 80,000 also you may get at 0.2 probability. Same way for the 70,000. When 70,000 you are able to get, 50,000 you may get in the first branch, 70,000 you may get in the second branch, and the third branch you may get 1 lakh. Okay. So like this, first 0 period you are going to make a 1 lakh investment. That investment may direct you in a 3-dimensional 40,000, 60,000 and 70,000. Each dimensional is going to give you further dimensional. Okay. So now, again, this is a printing mistake. So this is not a 0.3, this is 0.4. Okay. So this is 0. This is 0.2. It is a printing mistake. Okay, this is 0.2. Correct here. First year, the first branch is 0.2. Okay, so now we are going to calculate. So we are going to calculate, listen carefully with me. In the first branch, just a moment. So this is 0.2. So in the first branch, you are going to calculate like this. But 40,000 you are going to get it. In the 40,000 may give you the 3-dimensional. 60,000 either or 70,000 or 80,000. And each of them you have a certain probability 0.4, 0.4 and 0.2. So when you are sum up in this 0.4 and 0.4 and 0.2, you supposed to get a 1 pop. That is what the total probability. So if it is not there, there is a problem in the question. You can understand. So 0.2 and 0.4. If you are multiplying these two, you may get a 0.8 in the first year. Same way, 0.2 into 0.4, you may get a 0.8, 0.08. Same way, 0.02 and 0.02, you may get a 0.04. Okay, it is nothing but you are multiplying both the probability. First year probability is 0.2 and it has a 3 branches. The first branch is 0.4, 0.4 and 0.2. Sorry. And you are multiplying these two and you are able to get a 0.08 value, 0.08 as a value. And the last one is 0.04 as a value. Okay, well, simply you are multiplying these two. The first year probability, it was printing mistake, it was 0.02. So you are multiplying with this and you have a probability value. Okay, so this is what your probability value. Is it clear? So you are multiplying first year and the second year's branches you are multiplying. This is what you are able to receive the probability value. Is it clear? If that is clear, we'll move on to the problem for now.
Sir, how did we get that 11,526?
Yeah, that's what I'm coming. So you have to multiply the 40,000 multiply with the 0.2. How much you get? This will be 8,000. Yes. So we are multiplying. 40,000 is the first year value. That has to be multiplied by 0.2 as a first year probability in the first branch. So 40,000 into 0.2. So 40,000 into 0.2. 8,000 rupees. So first year you may get a 8,000 rupees. Same way for the second branch. 60,000 rupees you may get it, no? In the second branch, right? 60,000 has to be multiplied with 0.4. 60,000 multiplied by 0.4. So 24,000. So first year is you may get 8,000 rupees. Second year you may get a 24,000 rupees in this branch. The branch is this branch. Take some other color. Okay. This branch will give you the 8 plus 24. Same way that this branch. Same way like this. So each branch you are going to calculate the profitability. Is it clear, Appa? So in that way, we need to calculate the profitability. And then this is nothing but the NPV value. NPV value has to be multiplied with the corresponding both period probability value. Okay. So the NPV value you are going to arrive now. What is the NPV value of 11,526? Same way for the second period also. Same way for the second branches also. Like this, each branch you have a NPV value. So since our cutoff rate is given up, what is our cutoff rate? Just a minute. Okay. So our cutoff rate is 8%. Just a minute, hold on. I'll write it freshly. Okay. So listen with me carefully. So first year, there is a chances for getting a 40,000. Okay. Second year, in the one branch, there is a chances for getting a 60,000. So this is one branch. So like this, you have a 70,000 in the another branch. Like this, you have another branch is 80,000 rupees. Okay, va? Now, first year, this 40,000, I have to adjust it at 8% of time value of the money. How can I calculate the 8% value? Go to the calculator, click 1 divided by 1.08. So this is the first year value. Equal to how much? 0.9259. So 0.9259. That is the first year value when you take an 8% as an interest. Same way for the second period. Second period, how we can calculate? 1 divided by 1.08 power 2. It was 0.8573. 0.8573. 8573. So we have a 2-year value. The first year value is 9259. Second year value equal to 8573. Okay. So I am going to multiply first year with these two. Just a minute. 40,000 multiply by first year value for 9259, the PV factor. So 37,000 36. That is the first year value. Plus second year branch. This 60,000 you have to multiply with 60,000 multiply by 0.8573 second year value. What is the value you have now? 51,000. 51,438. So this value is complete. 37,036 plus 51,438. The total value equal to 88,474. Okay, ba? 88,474. So this branch, so we calculating corresponding value. Here 37,036 the corresponding value. Here the corresponding value equal to 51,438. So that total minus how much we are making investment. The investment value is given here 1 lakh. Just a minute. Okay. So that investment value equal to 1 lakh rupee. So we divide my getting a difference of that 1 lakh minus 1 lakh rupee. 11,526. Okay. So that is how we arrived. First year, this value, that is corresponding value, you are multiplying first year value at 9259. 9259. Second year, we are all multiplying with 0.8573. That value you are getting, and the difference between 1 lakh equal to, you are able to receive the NPV value. The NPV value for the first year, NPV value for the the second branch and the third branch. Like this, you calculating that has to be multiplied with the joint probability. Okay, this was 0.2, 0.2 and 0.4 will become a 0.8 actually, and 11,526 into 0.08. That value is known as the joint probability NPV value. Okay. So like this, I'm calculating the each branches for 0 period 1 lakh rupee as outflow. That 0 period you may get a first year 3 branches. each branches of the first year may give you the further 3 more branches. So you have like this one. So here you have 1 branches. This is the second branch. This is the third branch. Same way 1, 2, 3. Here also 1, 2, 3. So totally you have a 9 branches. So that 9 branches you have a NPV that has to be multiplied giant vertical joint probability, and you may get the value for that is expected NPV equal to how much about 20,177. Okay. So the expected NPV equal to 20,170. It's nothing but we are all taking all the possibilities, and this is the factor that is 20,177 is the risk adjusted cash inflows. That is net present value. Like this, you have to calculate each branch by showing you how you can calculate the first branch. Same way you can calculate for the second branches also. Same way you can calculate the third branch. You know the first year value, only this value you have to calculate. Same way, 60,000 first year, and that 60,000 will give you the further sub branches. Okay, you have to take first year value at 0.9259, second year value 0.8573. That has to be multiplied. You may get up each branch's value, and that branch's summation will be your expected NPV. Is it clear? You are able to follow me? There is a high chances for you may get that problem, that type of problem. Okay. If that is clear, I will move on to the next unit. We'll start next unit, unit number 3. These are all self-assessment question actually. Can I start next unit now? Unit number 3. Yes. If you have any doubt, let me know. Otherwise, we can go to the unit number 3. I will discuss some important problem in the unit number 2. Yes. Can I start?
Okay, sir.
Yes. Can I start the corporate restructuring? Okay, thank you. Yes. You said something I didn't get. So I think I can continue, no? Okay,
Yes,
thank you. So we'll move on to the third unit, corporate restructuring. So it is nothing but the restructuring the company's capital. That is called as in a corporate restructuring. So in organic, we said no, there are 2 forms of getting a growth. One is in organic form, another one is inorganic form. Inorganic form is nothing but quite popular nowadays. So we all know about the Tata groups, no? So Tata Group started their industry almost more than 150 years. It was established in the year of 18 itself, no? But it has established and it's grown in a organic way. It is nothing but they are not captured initially. They are not captured any companies. Slowly they have started their business and they got a good name. With that reputation, they keep growing. This is what called as an organic form of a growth. Any business, if you want, it will be called as an organic form. There is inorganic form also we have. So a particular company can acquire another company. Good profit making company they can acquire because those company may be established maybe 20 or 30 years before, maybe a decade before. So by acquiring that company, maybe the purchasing company also may get a reputation. They may get a good name. They may get a good profit. These are all called as an inorganic form of a growth. Okay. So in both are possible in a corporate. So what are all we are rearranging our business will be called as a corporate restructuring. Okay. So we all know there are 3 or 4 forms of a business. Any business we are going to consider, we call it as a sole proprietorship, the first method. The second one is called as a partnership. Third method is cooperative society, and the fourth method will be called as a company. It may be public limited company or joint stock company. Okay, so when the capital amount is very limited to me, so I can start my own sole proprietorship. Assume that I have 1 lakh rupee or 5 lakh rupee. So with it, I'm going to start a department store or provisional store. So, okay, so the capital requirement is just 5 lakh rupees. So entire capital is contributed by myself. So I consider as a sole proprietor of a business. Okay, let me put like this. So I'm going to start a pharmacy, medical shop. So for this, the capital requirement is just 50 lakh rupees. So assume that the 50 lakh is not a, what do you call, tolerance level, or maybe it was not contributed by individual person. In that time, maybe I know something how the company can, maybe how the pharmacy can be started, but I don't have money to start that. In that time, I may call my friends or relative who are contributing capital to the business. In that time, the business is known as the partnership business. The third, we all know the cooperative societies. Okay, so like a milk vending, Amul and all, it's like a cooperative society. In Pondicherry, we have a Panle, we have Amuda Surabi, we have a Pantex, we have a Panfair. So these are all the cooperative society. So it is going to work for the welfare of the particular society's people only. Okay. Same way, we have a company's method. It will be known as joint stock company. Okay. So in the joint stock company, it may be in the public limited company. Same way, we have a private limited company. So that we are not discussing elaborately. Okay, so like this, we have a 4 forms of business. Any business we're going to consider as 4 forms, like a sole proprietorship, partnership, it may be in a society, or it may be companies also. Okay, and these are the reason we are going to list out for why the corporates are restructuring their capital. The first one is to induce the highest earning or higher earning, because since you are keep earning a low profit, or you are not able to get a market share, in that time you may acquire another company. By acquiring another company, or by acquiring a profit making company, you may get a profit also, right? So that is why the people who are actually restructuring, these are the reasons actually. So they may look for the higher profit, and they may get a core competency. So recently we know that what they call it, 3 years before, the Tata Motor acquired the Jaguar. Okay, so Jaguar brand. So why they acquired? Actually to get a competence in the particular field. Okay, same way to get a diversified also. So you know about the ITC company, no, that is Indian Tobacco Corporation. It was initially manufacturing the same commodity like a cigarettes, and by acquiring in a small corporation, okay, so they are established their business in the FMGC also. Now ITC are able to manufacture biscuits, yeah, like Sunfeast we have, no, Sunfeast biscuits and all will come under ITC, and we have a what they call it, cycle agarbattis are come under ITC, and same way we have a what they call Mangal Dev, and even we have a classmate notebooks. These are all called as an ITC product. But initially ITC was known as the Tobacco Manufacturing Corporation, but they can diversify their business. Okay, so that is why they are restructuring the capital. Okay, and then to have a clarity in the vision and strategy, also they are restructuring the capital. Okay, so to get a leadership in a particular market, say for example, we have a horizontal merger and a vertical merger. So it will happen. But say, for example, the tire manufacturing company may acquire maybe in the rubber producing company, so that they may get the previous process and the next process. These all will be called as a leadership mechanism. So like this, there are many reasons for the corporate restructuring. So now we are going to discuss one by one what are the forms of restructuring we may have. Okay, well, is it clear? So there are many reasons. We cannot say only this reason only is going to take place for corporate restructuring. So we have discussed something, and with this we are going to discuss the what are the various forms of corporate restructures are available. In that, we are going to start with the expansion. Okay, so expansion is nothing but expanding our business for maybe Let me put like this. Earlier, I have operation in only in Chennai. Now I want to have operation in the Pondicherry also. In that time, I may need a fresh capital, no? So this is nothing but expansion. Okay. For the expansion purpose also, the corporate may restructure. Okay. The expansion is the first forms of the restructure. They may issue a share, a first debt, or maybe combination of both. Clear up? So I want to expand my business operation. Earlier, I have operation only in, let me, we all know about A to B, no, that is Adayar Anandabhavan Hotel. It was started in the Adayar only. But now it is having a branches even international also. London, it has their branches. They have branches in USA also. They have branches in France. So how these are all happening actually? So these are all happening because of expansion. So for this, they need a fresh capital, no? So that is the first forms of corporate restructuring. Second one is merger. Okay. So just a minute. Okay. The second forms of corporate restructuring is merger. So merger is nothing but joining more than or one or two companies and form a single company is called as a merger. Let me put like this: AB company creating a company or B company. This is called as a merger. Okay. Two or more than 2 to 3 companies join together and start their own operation. It is called as a merger. Okay. In that time, any one company may exist. Like Hero and Honda is started, no? So they are merged. We have a Hero Honda and they are demerged also. Like a Maruti and Suzuki, they have merged and they have a Maruti Suzuki. Right? Clear up. So this is nothing but they are merging, and once the merger is taking place, only one company will be in the available. Okay, so that company will be called as a surveyor or acquired company. Okay, so ABC company bought another company, maybe 2 to 3 company, and A company may be existed or B company may existed. This is called as a merger. Okay. The next forms of corporate restructuring is amalgamation. So amalgamation means that it refers to a situation where two or more existing company, combine into the new formed for the purpose, maybe any purpose. The old company maybe cease their exist and their shareholder paid for the new company shareholder. Okay, so this is called as an amalgamation. Clear? So amalgamation is nothing but if it is merger, let me put like this: A, B, C. There are 3 companies joining together, and A company only is existed. B and C are there lost their operation or they lost their identity. Mean it is called as a merger. Okay, so merger, 2 to 3 companies join together and then start their operation. Whereas in amalgamation, also same 2 to 3 company, but all the 3 company lose their identity and they may start a ABC corporation. In a simple company will be created, and the shareholder of the A and B, C's will get a ABC company shares, not a company share, B company share. Now, all the companies are formed in a one group, that is ABC corporation. The shareholder may get a ABC company shares. Okay, well, not a company. Assume that earlier I bought a company share. So once my companies are merged, I mean amalgamated, and I may get a ABC company share. Okay, well, so this is called as an amalgamation. Okay, so again there is a technical difference others given in the merger and amalgamation. In the case of merger, one existing company take over the business of another. Okay, existing company. Where in the case of amalgamation, new company take over the business or two or more new company, more existing company. Clear up? So in a merger, one company is going to acquire two to more than two company or more than three companies. Whereas in amalgamation, same process only, but new company is going to be formed after the amalgamation. Okay, is it clear? If that is clear, we can move on to the purchasing of a unit. Is it clear? Yes. Can I go to the purchasing of unit, the third type? Sorry, fourth type. Okay. So it is nothing but purchasing in a particular unit or particular plant is known as the purchasing of unit. Nowadays, it has become quite popular actually. In a particular unit, it was happened, recently, what do you call the Chennai branch of the Ford, which acquired by Tata Motor. Okay. So the particular branch or particular plant alone can be purchased. Okay, so recently the what do you call it, Chennai, Kanjipuram, there was 4 companies manufacturing it. That is purchased by Tata. Okay, so particular unit company, they need their operation purpose. They may need the company, what do you call that plant, and that plant alone can be purchased. This is called as a purchasing of a unit, not a company. Okay, so they will pay amount for that unit. That will be called as a purchasing of a unit. Clear? So the next one is takeover. If it is in a takeover, we may have two sub branches. That is, we call it as an holding subsidiary company. Okay, it is nothing but we are going to, that is, a purchasing company is going to acquire the shares of a what do you call, of a subsidiary company above 50% or 51%. If the company paid a capital is 100 mil, or maybe 1,000 number, or maybe number wise if you are calculating, okay, 51% of the shares may be acquired by the takeover company. Okay, takeover. Clear up? The particular company may acquire the assets of another company by paying in a share or any other forms also. Okay, the next one is business alliances. There is business alliances. Business alliances have some other branch, what do you call it? The divisions also. So business alliance venture. Okay. So joint venture, if you have studied in BCom or maybe in the first semester, in accounting paper, you may come across the joint venture and what do you call it? We can call it as a partnership. Both are technically same. Partnership firm and joint venture both are technically same. For occasionally, two or more capable firm, they can join together and form a company. Okay. So that company called as a joint venture actually. Okay. Separately, there will be a company A and company B. For the purpose of completing a particular activity, they may joint venture. Okay. Say, for example, L&T and Ultratech Limited join together to complete a particular, what do you call, particular road line or particular bridge construction or maybe particular building construction. So this will be called as a joint venture. Okay, so to complete that activity, they are joining together to complete that work. This is called as a joint venture. This is also part of the capital corporate restructuring. Clear up? The next one is strategic alliances. So we all know about nowadays the smartphone and all we are using. No? So these and all will be called as strategic alliances. Maybe a purchasing a Samsung mobile, but Samsung mobile powered by Android. Okay, wow. So these are all called as a strategical alliance. So two company, that is Samsung is the manufacturing company and Android OS is the software providing company, and both the company join together and they are giving a license. They can use their product and they can create in a product. No. So Android OS they are using in the Samsung product. So by that they called as a strategic alliance. So they are creating an alliance. With that, they're joining together. They're coming with a new product. This is called as strategic alliances. Again, we all know the purchases also. Right? Nowadays, if you are, I think if you are in the Pondicherry, maybe each and what they call nook and corner, you may have what they call the Karupatti coffee shop, or you may have a tea times. So these are all will be called as franchising. So a particular company established a name, and if you want to use that name, you can pay a royalty. Okay, so you can sell their commodity. Okay, so you can use their name, you can use their trademark, you can use that. This all will be called as a franchising. Okay, so we have a Raymond showroom, we have a, what do you call it, tea time shops, we have a Karupati coffee shops. Okay, so we have what do you call it, maybe in a McDonald's, we have a KFC. These all will be called as a franchising. So a particular company selling their identity by taking in a royalty. Okay, so these are all called as a corporate restructuring. So like this, we have a licensing also. Okay, so I think up to this I will stop. If you have any doubt, up to this you can ask me. Otherwise, we can conclude the today class. Maybe in the next week we can discuss about unit number 3. We'll start freshly. We can start. We can continue in the next class. If you have any doubt, let me know. Or otherwise, I can conclude the today class. Yes. Is it clear? Can I conclude for the class? Okay, thank you.
Thank you, sir.
Good afternoon. Good afternoon.
Good afternoon, sir.
Yeah, screen is visible. Screen is visible.
Yeah,
Okay.
visible.
The paper name is Merchant Banking and Financial Services. Yesterday we have to discuss about the introductions about financial services, classification of financial services, and emergence and development of financial services in India, and financial services characteristics, functions, importance, types of financial services, consequent of financial services, scope of financial services, and two important questions in our examinations point of view: fund-based and fee-based services. And finally, we have to discuss about financial engineering, its development in the sector, and the challenges faced by financial service sectors. So this is our first unit. Now move on to our second unit. Second unit is merchant banking. Merchant banking is a very, very familiar concept in the field of financial services. It's also done by the banking services. Not only for the banking services, other services is also done by merchant bankers. In case of banking services, normally we have rece- lending loans, receiving deposits, and lending loan. Not only for this traditional function, merchant banker is also doing the functions of portfolio managers, issue manager, lead managers, or underwriters, advisor, services. These function is also done by banking sector. Is also coming under merchant banking. Merchant banking is one of the major fee-based advisory services in our financial services. In 1969, the first merchant bank was started in India. The name is the Greenlay Bank. Commenced merchant banking division in India. This is the first bank is operating of merchant banking functions. The formal merchant banking services was originated in the year 1969. The bank started the activities related to public issue of securities like issue of equity shares, issue of preference share, that is issue of financial securities. They also undertook financial consultancy services. This is the first bank to started the functions of merchant banking activities in India. In the year 1973, the State Bank of India started merchant banking services. In 1974, the ICICI Bank started research services related to financial research, that is equity market operation, portfolio management, mutual fund activities. These research activities also under the year 1974. This is started by ICICI. After 1975, many merchant banking organizations came into existence in India. There is an operational activities related to security market, credit rating, ventures capitals, and a mutual fund, etc. Insurance, underwriters, all these functions existed 1979. The sponsor of these organizations were by banks, financial institutions, and non-banking financial institutions, brokers, and also some private agencies also undertook the functions of merchant banking. Consequently, nowadays the scope of merchant banking activities was widened related to the innovation and creation in the field of financial market. Initially, the new issue market was regulated under the provision of Capital Issue Control Act 1947 and rule made under it. But after the liberalization policies adopted by Government of India in the year 1992, the act was replaced. The protection of the interest of the investors was transferred to the Security and Exchange Board of India. That is, SEBI is giving the guidelines for functioning the operational activities of the merchant banking, and various regulatory measures covering both the intermediaries as well as the activities were introduced by SEBI of strengthening the operation of the new issue in the country. Many intermediaries who play an important role in the process of selling new issue emergement. That is one of the functions by merchant banker, issue of new issue market. The major new issue market intermediaries are merchant bankers, lead managers, underwriters, bankers to issue, bankers to an issue, register to issue, that is share transfer agent, debenture trustees, and portfolio manager. These are the major players are playing the new issue market. New issue market means that the shares are first time issue in this market, like IPO, initial public offering. The first one is merchant banker. The merchant, and one more important point is the legal framework prescribed by SEBI. The functions of these 8%, the legal framework prescribed by SEBI controlled the operation of these intermediaries. Whatever activities carried out by these intermediaries only abide the rules and regulations given by SEBI. The rules and regulations were framed by SEBI for prohibition of fraudulent and unfair trading practices related to the security market, and prohibition on dealing, communicating, or counseling on matter related to insiders trading. The first person is the merchant banker. A merchant banker means any person who is engaged in the business of issue management. Issue means issue of shares, that is pre and post issue. Issue management is comprising both pre and post issue management, either by making arrangements regarding selling, buying, or subscribing to securities, or act as a manager, consultant, advisors, or rendering corporate advisory services in relation to such issue management. One of the predominant roles played by merchant banker is issue management, that is issue of shares, that is up to the stage of capital class is also fixing the nominal capital, authorized capital, issued capital, and subscribed. All these things is managed by merchant bankers, and also issue at par, issue at premium, or issue at discount. All these things is consulted with the issue manager. So issue manager means any person who is engaged in the business of issue management, both pre and post issue management. A simple meaning is given in this: a financial institution that conduct underwriting, loan services, financial advising, and fundraising services for large corporates and high net worth individuals. So these are the meaning of merchant banker, and a simple examples about a merchant banker. For example, a company A want to raise fund worth rupees 10,000 crores from the market and decide to issue two securities. One is debentures. Debenture is a creditorship rights. It's simple like a loan. So issue debentures, debt fund. Debenture means debt fund, and preference shares worth the same amount. So the company A want to issue 10,000 crores. They issue two securities. One is debentures, another one is preference shares. Now they hire merchant bank. That is, it is a bank. So he's also doing the functions of merchant banking services. So the company A appoint as a lead manager to merchant bankers to ISET to oversee the issue and the sale of shares. The merchant bank ISET will use this expertise to create a detailed action plan and budget for the entire exercise, that is pre and post issue management. They will also hire and coordinate with the equity underwriter who will use their own distribution network to sell the debentures and preference shares of company A to investors. As part of the action plan, merchant bank ISET may also hire advertising and marketing activities carried out to issue the shares to the investors. And in addition, the merchant bank will obtain regulatory clearances from the relevant authorities like SEBI and handling the associated paperwork. So all the functions, whatever functions we have need to pre and post issue management, all these functions is undergone by the merchant bankers on behalf of the companies. And next one is the categories of merchant bankers. Normally there is a four categories. Merchant bank fall under four categories. The first category, this is a guidelines is given by SEBI, Security and Exchange Board of India. The category one merchant banker. What is the duty is done by this merchant banker is preparation of prospectus. Prospectus means all the relevant information included in this book. These prospectus comprising of issue management about the companies, about the vision of the companies, objectives, financial positions, and feasibility studies, and about the details about the issue prices, par values, all these things included in this prospectus, and other information related to issue. So the category 1, the functions done by merchant banker is preparation of prospectus and other information relating to issue, and determining the financial structure, tie up with the financial, other related financials are need for this, and the final allotment of securities, refund of securities, advisory function, consultant, co-manager, underwriter, or portfolio manager. These all the functions is done by the bank. The bank name is called as merchant bankers. That is coming under the category 1, preparation of prospectus, determining the financial structure. Financial structure means debt and equity portion, mix of debt and equity portions, and current liability position, and tie up with other financial institutions, and fixing the applications, allotment, first call, second call, and also refund of subscriptions, under subscription, over subscriptions. All these things is carried out by the merchant bankers, and advisory function is done by the merchant banker, consultant, managing functions, underwriters, and portfolio manager. These all are coming under category 1. The next category is these merchant banker is done only in the functions of advisory, not involving preparation of prospectus, approach to other financial, fixation of financial structure and capital, all these things. These category person is only doing the functions of advisory to the company, or consultant, co-manager, underwriter, and portfolio manager. The category 3 is only done the functions of underwriter, advisor, and consultant to an issue. And fourth category, advisor or consultant to an issue. Totally, there is a 4 categories, but all the categories below category 1 were abolished by SEBI on 5th September 1997. Before 1997 in India, there is 4 categories of merchant bankers, but after September 1997, only category 1 is approved by SEBI. Those operating below category 1 have to apply for category 1 status. Before 1997, there is 4 categories of merchant bankers in India, but after September 1997, there is only 1 category of merchant banker. The functions of merchant banker is at pre and post issue management, like preparation of prospectus, and includes all relevant information, approach to other financial institutions, tie up with the financials, fixing of financial structures and capital structures, and a allotment, that is a allotment stage, approved allotment stage, final allotment of securities, under subscription, over subscription, refund, advisory. All this is coming in the category 1. Category 1 is recognized in India. So this there is normally there is 4 categories, but after 1997 there is only 1 categories of merchant banker in India. Next, who is a merchant banker? What are the conditions to be fulfilled by merchant banking functions? Registration of merchant banker. Registration of merchant banker with the SEBI is compulsory to carry out their activities with effect from 9/12/1997. SEBI registered only Category 1 merchant banker. A separate certificate of registration from SEBI is required to carry on activities as portfolio managers. What are the conditions is laid down by merchant banking function in SEBI means the matter considered by SEBI for grant of certificate of registration. The first condition is the merchant banker should also be a body corporate, not individuals as doing the functions of merchant banker, only the body corporate other than non-banking financial companies. So only the banking concern is only doing the functions of merchant bank activities, not other than non-banking. So the merchant banker should also be a body corporate other than non-banking financial companies. This is the first condition. Second one is the merchant banker must have necessary infrastructure such as place, equipments, that is office buildings, place, equipments, and manpower to effectively discharge their activities. So I simply explain about the place of function of doing the business, manpower, and the infrastructure. All these things coming into the second condition. So the second condition is the merchant banker must have necessary infrastructure. Third one is the merchant banker must have employed at least two-person with the experience to conduct the merchant banking business. So at least two-person is engaged in the functions of merchant banking activities. And the fourth condition is the merchant banker should fulfill the capital adequacy requirement of minimum net worth. Like in India, there is a 5 crores. That is a minimum net worth of rupees 5 crores. Net worth means your paid up capital and resource and surplus. That is the meaning of net worth. So your net worth value is rupees 5 crores. So you have fulfilled this capital adequacy requirement, then only you apply for SEBI to act as the merchant bankers. And any person either directly or indirectly connected with the applicant, like corporate, that is an associate, subsidiary, or interconnection or group company, cannot have a certificate of registration from SEBI. So simple meaning means there is no linkages between the corporate and the merchant banker in any way. In case of your associates, subsidiaries, or anything. So any person either directly or indirectly connected with the applicant. Applicant refers to the corporate, that is an associate, subsidiaries, and organizations, companies cannot have a certificate of registration from SEBI. And the next condition is the merchant banker, their parents, their directors, their directors, principal officers should not be involved in any litigations. That is, there any unlawful activities connected with the security market, which has an adverse effect on their business. And the last condition is the merchant banker should have recognized professional qualification in the field of finance, law, or business management. So the person is knowing about the legal aspect and the financial aspects and the management. Then only the person doing the job in well manner. So the person is qualified as the recognized professional qualifications, maybe in the law, in the field of lawyers, or maybe you are maybe a finance or finance business management, maybe CA professional course like CA, CMA, or ACS. So the person is very well know about the legal aspects, business management, that is management aspects, and main important thing, the person is well versed in the field of finance. The person is know about the financial accounting aspects, financial aspects, security market aspects, investment activities. Maybe sometimes the person is also know about the international quantitative knowledges like statistical knowledges. All these things is required as a person doing the jobs of merchant banker. So the merchant banker should have recognized professional qualification in the field of finance, law, or business management. So the registration should be in the interest of the investor. As you are doing the functions of merchant banker, as you are an agent to the corporate, but whatever decisions you have to take is only to the interest of the investors, not for the corporate. The applicant must be a fit and proper person as per the criteria specified in the SEBI Intermediaries Regulations Act 2008. So there is separate act for the rules, regulations, duties, responsibilities, and also the liabilities of the intermediaries. All these things is mentioned in SEBI Intermediaries Regulations Act 2008. So the applicant must be fit as per the rules and regulations given by SEBI's Act 2008. So these are the main conditions related to registration of merchant banker. First one is the, as a body corporate, proper infrastructure you have to need to doing your functions, employed at least two-person as well qualified in the field of finance, law, and management. If you require the net worth of rupees 5 crore rupees, you are not involved directly or indirectly connected with the applicants. You are not involved in any litigation, any unlawful activities related to financial aspects like security market or any other scams or any other fraudulent activities. You are not involved like that. You are doing the functions of merchant banker. Next is fees payable. As you are a merchant banker, you have to pay some fees to the SEBI. The merchant bankers have to pay to the SEBI the following fees. First one is application fees of rupees 25,000. As you are applying for a registration purpose, you have to apply 25,000. Application fees is 25,000. Registration fees is 10 lakh. The registration is valid for 3 years from the date of registration, and after that you have to renewal. After 3 years you have to renewal. You have to pay 5 lakh rupees. So the merchant bankers have to pay to SEBI the following fees: application fees, registration fees, and renewal fees is rupees 5 lakhs. The next question is corporate functions of merchant banker. These are the major and important functions are listed here. That is corporate counseling, project counseling, pre-investment studies, capital restructuring, credit syndications and project finance, issue management and underwriting, portfolio management, working capital finance, merger, amalgamations and takeover, venture capital, lease financing, foreign currency financing, and a mutual fund. The first one is the corporate counseling that is related to issue management. That is advisory function is done by merchant banker related to issue management. For example, you are issuing at what face value, and also for fixation of your capital class, maybe your liability class, all these things coming under corporate counseling. Project counseling, preparation of your project report at the time of feasibility study. Start from feasibility studies to, and after that there is an investment appraisal system. There is number of system is there. There is number of techniques is there. All these techniques is done by merchant bankers, and finally prepare your project report. And a pre-investment studies means it is a detailed feasibility study to evaluate alternative avenues of capital investment in terms of growth and profit prospectus. In case you are not directly involved in any one investment avenue, definitely you have an option. After screening the option, finally you have to select it which one is best related to the environment. Depending upon the environmental situation, which project is feasible to you. That is pre-investment. That is activities relating to pre-investment studies are analyzing environment and regulatory factors. Environment in terms of our Indian economical situations, like political situation, cultural situation, technological situations, maybe legal aspects, regulatory measures. All these things is considered for pre-investment studies. So in case of pre-investment studies, the activities are done by merchant banker is analyzing the environment. That is the environmental scanning. What is strengthiness? What is the strength and weakness? Whatever opportunity is there? What is the problem faced by the companies in terms of these project appraisals? All these things there, and identification of raw material sources, availability of raw material, estimation of demand, supply, customers' perceptions. All these things is coming under pre-investment, and estimation of financial requirement, both in terms of long term and short term. That is long term in terms of capital budgeting decision. In case of a short term working capital management, that is current asset and current liabilities management. All these things is coming under pre-investment studies. The next one is the capital restructuring. That is, capital restructuring is main aim to reduce the cost of capital and maximize the shareholders' wealth. Cost of capital is simple like a minimum rate of return expected by the sourcer of funds. Whenever the cost of capital is minimum, the value of firm is maximum. So that way you have to fix your debt and equity management. Next one is project financing. In case of short-term finance, long-term finance, how to acquire this finance, what is the possibilities for acquiring this finance based on the projection of the project. All these things coming under credit syndications. And the next one is the issue management and underwriting. Issue means pre and post issue management. Underwriting means on behalf of the companies, the mentioned banker is undertaking some portion of the shares and then is issued to the investors. It's simple like a functions of agency functions. And portfolio management. Portfolio management, diversification of funds. All these things is done by the merchant bankers. And working capital financing. So this financing is a fund required to meet the day-to-day expenses of the business. It's simple like a current asset and the current liability management. Is like a liquidity management, and is also doing the functions of mergers, amalgamations, and takeovers, And venture capital function is also done by merchant by seed capital providing to the merchant banking for to the entrepreneurs for these innovative ideas. All these things is also coming under merchant banking functions. And also leasing financing, that is operating lease, financial lease, maybe yesterday we have to discuss sales back, core sales back, all these things coming under lease financing. Foreign currency management is also underwritten by the merchant banker, that is a transaction risk, translation risk is also is coming under fixed rate, fluctuating rate, all these things considered by the functions of a merchant bankers. And finally is also doing the functions of a mutual fund. So these are the major functions is done by the merchant bank in India. The first one is the corporate counseling, second one is project counseling, third is pre-investment studies, capital restructuring, project financing, issue management, portfolio management, working capital finance, merger, amalgamation and taken over, venture capital, lease financing, foreign currency management, and finally mutual fund. These are the first intermediaries listed by SEBI, merchant banker. The major new issue market intermediary is the first one is the merchant bankers. This is the important point you have to know about the categories. First one category is only recognized as SEBI after 1997. Other before 1997 there is four types of categories, but now there is only first category only is approved. Next, role of merchant banking. The role of merchant banking, the first one is management of the customer securities and management of the portfolio, management of project and counseling, management of interest and dividend, arrangement of loans, and factors affecting the growth of merchant banking. That is the policies, regulations given by SEBI. SEBI is monitoring the functions of merchant bankers on the welfare of the investors. So factors affecting the growth of merchant banking law. What there is a guidelines given by SEBI, you have to obey or abide the rules and regulations given by SEBI only. You are not beyond the guidelines given by SEBI. In case if you go further, there is a liability, there is civil liabilities, maybe industrial policies, economical conditions, economical environment of the, that is international economic conditions means refer to a domestic level in India. In case of economic environment outside, but international factor is also affecting the functions of merchant banking. And also there is a huge competition nowadays for merchant banking services, private institutions, financial institutions, all are coming very stiff competition in the field of merchant banking. So these are the factors affecting the growth of merchant bankers. At present, the following banks have merchant divisions in SEBI: SBI, BOI, Bank of India, Syndicate Bank, Bank of Baroda, Punjab National Bank, ICICI Bank, IFCA banks, IDFC. These are the leading banks to run the functions of merchant bankers in India at present. And there is challenges faced by merchant banking. They need to innovate and deliver new products. Our environment is very dynamic, and the government is also changing the policies. SEBI is also changing the policies. So there is a lot of dynamic situation is arises. It's one of the important challenges faced by merchant banking. And providing integrated view to the client is facing there is a lot of conditions given by SEBI, and as well as for the Companies Act is also giving some guidelines about the functions of merchant bankers. So you have to follow all the rules and regulations laid out by statutory bodies. And offshoring of business is very, very increasing nowadays. And also this having some risk management in the field of merchant banking. The second person is, the first person is the merchant banker. The second person name is lead manager. At least as per the SEBI regulation, all issues should be managed by, in case if you are a corporate, you are going to issue a share, you have to appoint one person. The person name is called as lead manager. As per the SEBI regulation, all issues should be managed by at least one authorized merchant banker functioning as sole manager or lead manager. Lead manager is also a merchant banker, but these banks doing the functions of issue of shares to the company, the person name is lead manager. Number of lead managers as per the SEBI guidelines, you have to, this is the guidelines given by SEBI, just you have to follow these guidelines. The SEBI guidelines stipulated the following: For the issue of size less than 50 crores, the number of lead managers should not exceed 2. For the issue size is, that is, if you are going to issue equity shares, the issue amount is 50 crores, means you have 2 lead managers. For the issue of size 50 crores but less than 100 crores, 50 to 100 crores, the maximum number of lead managers should not exceed 3. 3 lead managers. For the size of issue 100 crores but less than 200 crores, the maximum number of lead managers should not exceed 4. And for the issue size is 200 crores but less than 400 crores, the maximum number of lead managers should not exceed 5. And the last one, for an issue is above 400 crores, the number of lead managers may be 5 or more, as may be agreed by SEBI. In case if you are appointed more than 5, you have get an approval from SEBI. So lead manager means the person who is doing the functions of issue management. It may be a merchant banker. The merchant banker is doing a functions of issue management. His name is called as lead manager or sole manager. Number of lead manager is approved by SEBI means up to 50 crores 2, 50 to 100 crores 3, 100 to 200 crores 4, 200 crores to 400 crores 5. More than 400 crores, you have to appoint 5 lead managers. And in case if you need more lead managers for monitoring and doing your issue management, you get an approval from SEBI for the appointment of the lead managers. Next, what is the responsibility of the lead manager? Every lead manager must sign an agreement with the issuing companies. So the first and foremost means there is a contract arise between two persons, lead manager and the issuing companies. The agreement must contains the matters regarding mutual rights, liabilities, and obligations relating to issues, which must necessarily include disclosure, allotment, and refund. All these things are included in an agreement. So there is a contract between the two person, lead manager issuing companies. The contract is containing related to rights, liabilities, and obligations related to issue, and also include the disclosures, that is about your issue, your application, allotment, and your refund procedures. All these things are included in this agreement copy. And the second is the merchant banker should furnish a statement specifying the details in the agreement to SEBI. That is, whatever agreement you have, that agreement is filed to SEBI. Such a statement should be sent at least 1 month before the opening of the issue for subscription. So first you have entered an agreement with the company, and this agreement copy is sent to SEBI 1 month before your issue of securities. These statements should also contain the details about all lead managers. In case some companies there is more than 1 or 2 lead managers, that is also included in this copy. How many lead managers are playing the role as lead manager and their respective responsibilities if there were more than one lead managers or merchant banker. First, there is an agreement entered between lead managers and companies, and these agreement copies is submitted to SEBI at least 1 month before issues. These agreement copies also included the lead managers. In case more than one manager is playing the role of lead manager, this is also included in the agreement. There should be no association between the lead managers and the issuing companies. So there is no personal linkages between these two person, lead managers and the companies, and there should be no association with the other merchant bankers who do not hold a certificate of registered with SEBI. And next one is the minimum undertaking obligations to be accepted by lead manager is, that is lead managers, 5% of the total underwriting commitment or 25 lakhs, whichever is less. So the minimum undertaking obligations to be accepted by lead manager is 5% of the total underwriting commitment or 25 lakhs, whichever is less. And the lead manager should furnish a certificate to SEBI 2 weeks before the opening of the issue of subscriptions, and the merchant banker must submit to the SEBI 2 weeks before the date of filing the registration of companies to the regional stock exchanges or both. You have to register, you have to send your agreement copies, all the details to SEBI as well as to the regional stock exchange or both. And the merchant banker should pay to the SEBI the following fees prescribed. That is, you are playing the role of lead managers. This conditions is laid down by SEBI. In case of public issue, what is the issue size and fees given to lead managers up to 10 crores, the flat rate of rupees 25,000. These all are legal aspects. All these things is given by SEBI guidelines. So you have to follow the guidelines. You have no right to changes or modify all these things. Whatever conditions is laid down by, whatever rules and regulations is laid down by SEBI, you have to follow the rules and the regulations. That is up to 10 crores, the flat rate of 25,000. 10 crores to 5,000 crores, that is commission, that is 0.025% of the issue size is the fees payable to SEBI. And 5,000 crores to 25,000 crores, 1.25 crores plus 0.065 for the issue size exceed of rupees 500 crores, and more than 25 crores, flat charges of rupees 3 crores is the fees you have to pay as you are paying as a lead managers. Next, in case of right issue, public issue means direct issue to the public. Right issue means the shares are directly issued to the existing shareholders. In case if you are to go for issue for right issue, your charges is up to 10 crores, the flat rate of rupees 25,000. 10 to 500 crores, that is 0.005% of the issue size. More than 500 crores, the flat charges of 5 lakhs. So this is the conditions given by SEBI as we are paying the fees as the lead managers. The first person is a merchant banker, the second person is the lead manager, the third person is an underwriter. Underwriter means the underwriter to issue of capital are one of the important intermediary in the new issues or primary market. They agree to take up securities which are not fully subscribed. That is, for example, a company issue 1,000 shares to public, but public is accepted only for 700 shares. So there is an under subscription. 300 shares is not accepted by public. So if you are issuing 1,000 shares to the public is accepted only 700 shares. That is under subscription. Like the case of Hyundai, that is an under subscription. They make a commitment to get the issue subscribed either by others or themselves. Now the person is agreed to take up the shares. Those shares are not accepted by public. In case these shares, the underwriter is also sell to the public directly, or he is holding the shares, balance 300 shares. That function is done by the underwriter. Underwriter is a person is very need at the time of under subscription of the company. So underwriter to issue of capital are one of the important intermediaries in the new issue or primary market. They agree to take up securities which are not fully subscribed by the public. They make a commitment to get the issue subscribed either by others or themselves. Maybe you have to sold the balance share to the public if possible. Otherwise, the shares are held by the underwriter. If you are doing the functions of underwriter, you have get prior permission from SEBI and also follow the guidelines given by SEBI. If you need the certificate of registration for functioning as an underwriter, you have to follow the guidelines given by SEBI. The first one is the infrastructure adequacy. It's like an office space, equipments, and manpowers to discharge the activities relating to underwriting. So that is first one is the infrastructure facilities, you have that. And the second one is the applicant must have experience in underwriting. So you have and well experience in underwriting about the issue management, pre and post issue management, subscriptions, in case over subscriptions or under subscriptions, whatever conditions is given by SEBI, all these things is well known by the person who is doing the functions of underwriter, or he must appoint at least two-person with the experience in it. For example, bank as underwriter, the bank is appointed minimum two-person. He must appoint at least two-person with the experience in it. The next one is the applicant or any person directly or indirectly connected with the applicant has not been granted registration with the SEBI as underwriter. You are not involved directly or indirectly, not only for you and your partners, or any directors or any members not linked to the applicant. The applicant of underwriter should not have any disciplinary actions taken against him under the SEBI's Act, were not involved any unlawful activities or any fraudulent activities related to the acts prescribed by SEBI, any financial scams, crimes, or anything. That is SEBI acts, rules, regulations. You will not have any disciplinary actions. The applicant for underwriter should have net worth of not less than 20 lakhs. Net worth means your paid up capital value and reserves and surplus. You have the value, that is your net worth is not less than 20 lakhs. And the applicant for underwriting should not have been found guilty of any economic offences and should not have been convinced of offence involving moral tribute. So you are not involved in any offences in case of economic related offences, any scams or anything. So you are not involved in it. And the application fees for underwriting is rupees 25,000. The fees payable for registration at the time of grant of certification is 10 lakh. Application cost is 25,000, and the registration certificate value cost is 10 lakhs. And in case you go for renewal, your renewal fees for 5 lakhs every 2 years from the fourth year from the date of initial registration is payable. So there is 5 lakhs for renewal fees every 2 years you have to pay. The application fees is 25,000 and the registration fees is 10 lakhs and the renewal fees is 5 lakhs for every 2 years. What is the responsibilities of underwriter? The first and foremost, to protect the interest of the client. Client in the sense the corporate. As you are doing the functions of underwriter, you are first responsible to protect the interest of the client and maintain high standard, maybe integrity, dignity, and fairness in the conduct of the business. Normally, as maintain a normal business. And next is to render high standard of service and maintain professional ethics and to exercise due diligence, doing his job in a perfect and abide by the rules and regulations, and to ensure proper care and professional judgment, make a right decision at the right time, depending upon the environmental changes. Maybe nowadays the environment, the market is heavy volatile. In these situations, you are having the quality for taking the right decision. It's not affected to the client as well as to the investor. So you are ready to take the decision in proper care and professional judgment you take at the time of uncertainty or volatile time, and to avoid conflict of interest. There is no misunderstanding or misrepresentation between the client and your underwriters, and to make adequate disclosure of his interest. Whatever information you have to disclose, all the relevant information you have to give to your client, to treat all its client without discrimination. One bank is doing number of companies as an underwriter, so you are not discriminated, you are not adequate. They treat equally all the clients without discrimination, and to maintain appropriate level of knowledge and competency in the field of finance management and legal aspect is very known. Very know about the SEBI's Act. The underwriter is the person is well known about the SEBI's Act and whatever rules and regulations given by SEBI, to abide by the provision of the SEBI's Act, and to furnish true and complete statement, that is where material factors fully disclosure in any documents, reports, report papers, without surpassing any facts, without hide anything or making untrue statement. So you have to furnish the true and fair view of your report to the SEBI as well as client as well as investor. So you are not hiding anything. You have to fully disclosure all the relevant factors facts you have to disclose to the public, client, and investors, and also having the material evidence you have that you are doing any function related to the issues management or your subscriptions. All these things you have to publish in a true manner, and you should not have any insider trading activities, and you should not engage in unfair competition harmful to the interest of other underwriters. You are doing it, you are not involved in any unfair activity to other underwriters is affected. So these are the major responsibilities to the underwriters. The fourth person is bankers to an issue. Bankers to an issues are engaged in the following activities. The first one is acceptance of application from the investor in respect of issue of capitals, and the second is acceptance of applications money and a refund of application money. Bankers to an issue in the following are the three important activities done by bankers. First one is acceptance of on behalf of companies. Bank is also doing the functions of merchant banking. That is what is the function is done by the company issue the share. The applications are accepted by the bankers. Acceptance of applications from the investor in respect of issue of capitals after the acceptance of application, and also applications money is also received by bank, and a refund of applications money in case you are not allotted shares. Some applications monies are refunded to the investor. So these three major functions is done by bankers to an issue: acceptance of application from the investors, and acceptance of applications monies, and in case if you are not allotted shares, refund of applications money within the stipulated period. And a requirement: if you are a banker for doing this, if you are doing the merchant bankers for issue of shares, you need some requirements. The first one is the necessary infrastructure. The applicant must have, maybe the banker, the applicant must have necessary infrastructure, communication and data processing facilities and manpower to effectively discharge its functions as a banker to an issue. As you are doing the functions of merchant banker, you have necessary infrastructure related to your infrastructure means the case of building, proper communications and the data processing facilities, and the manpower is very very important. The manpower is also the qualified manpower is important for doing the job. The person is know about the company 2013 SEBI guidelines, and also monetary policies is know about very well about Reserve Bank of India's policies, monetary policy. So a well qualified person you got appointed for doing the function. The infrastructure is also included the manpower, not only for data processing facilities, buildings, all these things. Manpower is also an infrastructure. So it's required necessary infrastructures for doing these functions. And the applicant, that is the banker, or any of the director of the applicant should not have been involved in any litigation, that is any unlawful activity connected with the security market. You are not involved in any unlawful activities related to security market. So there is no litigations. And the applicant should not have been convinced by any economic offenses, not only for the security related, any other, not involved any other economic offenses. The applicant must be a scheduled bank, that is commercial bank, and the grant of certificate should be in the interest of the investors. So the whatever functions is done by merchant banker only with the interest of the investors, not for the client. Maybe whatever decisions taken by the bank are doing the function related to interest, the grant of certificate should be in the interest of the investors, and the applicant should be a fit and a proper person as per the criteria specified in the SEBI Intermediate Regulations Act. There is separate act for SEBI Intermediate Regulations Act 2008. This is clearly explained about the rules, regulation, functions, responsibilities and liabilities of the intermediaries. In case as a bank for doing the functions of merchant banker, you have to follow the rules and regulations given by SEBI Intermediate Regulations Act 2008. the responsibility of bankers to an issue. The first responsibility is furnishing information to SEBI. The banker to an issue must furnish the following information is required by SEBI. Whatever you have to submit the report to the SEBI. The information includes number of issue for which he is a banker. One banker is not only doing the functions of one company. Maybe the bank is involved the issue management number of companies. So you have to mention number of issues for which he is a banker. For example, a banker doing the functions of more than 2 companies or 3 companies. You have to mention it, the name of the company, what is the minimum subscriptions value, what is the issue management subscriptions value. So all these things you have to given. So the banker to an issue must furnish the following information is required by SEBI. The first one is number of issues for which he is a banker. The second one is number of applications you have to receive. For example, yes company issued share to the public. For you have received 1,000 applications. So you have to mention 1,000 applications you have to receive. 1,000 applications money is also received. So the details of applications money received and the date of forwarding the application to the issuing company or register to the issues and date and amount of refund of to the investors. All these things you have to furnish to the SEBI. So number of issues for which he is a banker and the number of applications you have to receive. Maybe more than 3 companies or 4 companies, you have to detailedly mention. For example, X company 1,000 shares, 5 companies 500 shares. You have to mention clearly, and also detailed of applications money received and the date of forwarding the application to the issuing companies. After the allotment is completed, go for refund. That is date and amount of refund to the investors. And the maintenance of accounts and documents. The banker must maintain records, documents, accounts for furnishing information to SEBI when they require. He must keep the record for 3 years. Once the company is going for issue management, you must maintain the records for 3 years. Maybe after the allotment is over, you have to refund money to the public, whatever the case may be. But you have to maintain 3 years. You must keep the records for 3 years. The banker must maintain records, documents, accounts for furnishing information to SEBI when they require. And entering agreement with the issuing companies. First one is maintenance of accounts and documents. Second is entering agreement with the issuing companies. The agreement entered into by the bankers with the issuing company must provide the following information. That is, number of collection centers at which applications money received is forwarded to register. So how many collection centers opened by the bank for issue management, and the submission of daily statement stating that number of applications and amount of money received by the investors, or any discipline actions taken by RBI against the bankers to an issue recording the issue payment must be informed to the SEBI. So how many collection centers you have, how many amounts you have to collected, on the basis of daily statements you have to submit. In case any discrepancy arises or any action Reserve Bank of India is taken by the bank, that is also mentioned to the SEBI. So these are the first four persons we have to complete about the merchant banking. In case of you need to start from merchant banking. The major new issue market intermediaries are merchant bankers, lead managers, underwriters, bankers to issue. Now you have to complete these 4 persons: merchant bankers, lead manager, underwriter, bankers to an issue. Next is brokers to the issue. That is, brokers are the person mainly concerned with the procurement of subscriptions to the issue from the prospective investors, maybe financial institutions or private banks is also doing the functions of brokers, or registered stock broker. Maybe if you are a broker, you are registered SEBI, you are doing the functions of brokers. Now Crow, Angel One, all these things as a brokers to issue shares. These persons, whatever condition is given, brokers are the person mainly concerned with the procurement of subscription to the issue from the prospective investors. Are the brokerage rate is 1.5% for all type of public issues, industrial securities. Maybe it is immaterial whether the issue is underwritten or not. The brokerage charge is 1.5% for all type of public issues, and the stock brokers have to meet mailing cost and other out of pocket expenses for canvassing of public issues. The company will not pay these expenses, so the brokerage rate is 1.5%. The broker has to meet mailing cost and other expenses related to the issues. The company will not pay these expenses, and the agreement with brokers and company should include a class to the effect. So the agreement with brokers and company should include a class, that is a separate class is laid out by SEBI's Regulations Act, is given detailed about the functions, rights, duties and responsibilities of the brokers. The brokers as abide the rules and regulations and agreement, whatever conditions given in the agreement, the brokers have to follow. Next one is the brokerage and private placement of capital payable by the listed companies. The brokerage rate is 0.5%. In case of private placement, in case of public issue, there is 1.5 percentage, and the broker is to meet all the cost and the expenses, and the agreement and the broker has the rights only with the limit of the agreement, whatever conditions between the companies, and also follow the SEBI guidelines. In case of a private placement, the cost is 5%. So this is the broker steward issue. So 5% today we have to complete it. 5%. Today we have discussed about the intermediaries, the major new issue market intermediaries. Today we have to complete it 5%, that is merchant bankers, lead managers, underwriters, bankers to one issues, brokers to one issues. Next class we have to continue with the other brokers about the registrars, share transfer agents, debenture trustees, and three more persons we have to discuss in the next class. Before that, you have to go through your books. This part is purely law. So there is a conditions given by SEBI. You have to follow whatever rules, regulations, all these things given by SEBI, and also you have to search some other SEBI website. Also, there is clearly given the functions of each person, that is mentioned bankers. All these things is clearly given. You have to follow that materials you also is taken, and once you go through this one, there is a detailed explanations about in your book. So you go through the first unit also financial service, and second unit mentioned bankers and all these things. Next we have to discuss a summary about all past 2 units, and we go for the next unit in the next class. Thank you.